What's up, everybody? Eric here. I've got a special guest today, Dylan, also known as Blue Suit on Twitter. He's also got a YouTube channel. Dylan, how's it going today?
Good. So it's Blue Suit. It's at Blue Suit Dillon, and blue is not even spelled right. It's BLU.
I got it on the screen. They can see it right on the screen. So
okay, cool. Because
yeah.
Honestly, I am bad at spelling. I'm really good at numbers, not the best at spelling.
Right.
And then I also had a YouTube channel as well, but I don't really do that anymore. I do more Substack.
Focus more on Twitter and Substack. So, Dylan and I have kind of connected on Twitter. They call it FinTwit, and there's only a handful of people that are really focused on investing and being positive and trying to think about the long term. And so we kind of get grouped together often, especially in that FinTwit universe, as a handful of accounts that are trying to help long-term investors. And I post about this all the time. I posted tonight on Twitter, unpopular fact, trading is not the same as investing. And of course, you always get tons of comments, right? But it's true. I mean, traders try to tell investors what to do. I don't see many investors telling traders what to do, right? So anyway, I can go down a rabbit hole there. But we know each other through the FinTwit community. Interestingly, we both lived in Minneapolis around the same time, but we didn't know each other in real life. So it's kind of a small world and the connection that way. What we're going to do today is we both focus a lot on the macroeconomics. So we're going to talk about macro, make this collaborative. We'll both share our portfolio strategies and talk about our favorite stocks. We're going to share 3 or 4 of our favorite stocks each. You're going to get 6 or 7 stock picks here towards the end. So you'll definitely want to stay tuned for that whole thing. But yeah, let's kick it off and let's talk about the macro. So when you think about the macro, of course, we've got just a whirlwind of negativity. And this really started when the Fed came out being hawkish, announcing quantitative tightening. And we knew that inflation was a thing, but Jerome Powell said it was transitory and we didn't have to worry about it. Of course, we've proven now that that's not the case. And I've got this article here. It's actually from Deloitte Insights. And I'm just going to pull this up on my screen. I'm going to share my screen with you for 1 second here. So at first, it was one of those things where we started to get a sell-off. And you look at economists, you look at optimists, it's like we're looking for reasons why it's not that bad. And the reality is the data has really been coming in worse than expected. We had our CPI report this last month, and it was higher than expected, on a lot of the areas. And you looking through this, I don't know if you ever look at this, Dylan, but Deloitte Insights, this was just on the 20th. So week of June 20th, a couple of days ago, it came out. And it does a really good job kind of breaking down. I know you write a lot about this stuff too on Substack, but you look at the consumer prices, so 8.6%. A lot of you guys know this already, right? But we've got inflation that the highest we've seen in more than 40 years. Okay, you look at on and on. I'm going to have you jump in and share some of your thoughts with some of the economic data, because we know we've got inflation, we got interest rates. We just raised 75 basis points. We still have the war with Russia, Ukraine. Now, oil prices look like maybe gas prices. They've started at the top. In fact, oil, crude oil has come down quite a bit from the top as well. So, that could be a positive. What are you seeing right now on the macroeconomic side?
Yeah, this is a wonderful question, because I think that when people try to make sense of what's really going on in the first place, we can get bogged down with a lot of the nitty-gritty data points. As Milton Friedman once said, I'm not sure if you've studied Milton Friedman too much, but he's a famous economist, where he ended up saying one time, he said, inflation is and always will be a monetary phenomenon. When we think about inflation and what's really going on these days, like we can say it's supply side, we can say demand destruction, or there's too much demand, or whatever really it might end up being. But if you apply Milton Friedman's principles to inflation these days, essentially, because the government spent too much money,
right, this
essentially created the end of a market cycle is essentially what it ended up doing. So when it's I can ask my wife this question, and then she even answers it. She said, well, if you print a bunch of money and if you give a bunch of people money, then of course you're going to get inflation. At first, as Milton Friedman ended up saying, it always seems rosy and it seems really awesome at first. Right. All of our stock prices were flying through the roof, AMC, GME, Dogecoin, all that other stuff. But what ended up happening is that it was like a liquidity tsunami.
Mhm.
that flooded through the system. At first, it hit the financial markets, and then it started spreading into all these other areas.
Right.
And now we're seeing a lot of narratives right now that it's a lot more sticky than what it used to be. So it really begs the question as to why did we just experience years and years and years of deflation? Why could we have gone through multiple different cycles of QE, since 2008? Why were we able to print so much money in the bottom of 2008 as well? Like,
Right.
why was the Fed able to expand their balance sheet so much and not have any sort of inflation like what we're having right now? And the answer is relatively simple. It's globalization, right?
Right.
You used to have this black hole, we used to call it this inflation black hole called China, where you
Right.
could outsource all the labor. You could just basically export a lot of the dollars in our system. But what ended up happening recently with COVID, and then also the Russian war, that did exacerbate the problem, is that you had the perfect storm. You had coronavirus, which
Right.
deglobalized the world, right? We shut down our borders. We said we're not going to trade with anybody. We're going to restrict travel. So you basically deglobalized the world. In addition to that, you had the government printing just enormous amounts of stimulus. It was like $5 to $6 trillion. And then even with the American Rescue Plan that was passed, I think it was January, February 2021. This also exacerbated the problem because the economy was also on the mend. But when you pushed another $2 trillion out there, well, then all of a sudden that's when you really got that spike. You actually ended up seeing in that RK ETF, and then you kind of saw the trickle effects throughout the financial system. But then inflation just progressively got worse and worse and worse over the years. So we didn't have the globalization that we ended up having in 2008. So if you really just break it down, make it simple, I understand that gas is really, really high, and that is also policy driven. That is also going to be macro driven, meaning it is driven by the war. It's the perfect storm of this inflation, right? And if we really just make it simple,
and
they printed too much money and they locked us down.
And to simplify it even more, I mean, you think of gas prices, you've got a lockdown where way less people are driving, so you don't have the demand, right? So
Yep.
Some of our refineries, a lot of people, they confuse crude oil with refineries and the actual gas that you use to drive with. Well, you have to be able to refine that into a product that's usable for gas. We closed down several of those refineries during that time as well. And so now you have less ability to create, supply, and you've got increased demand overnight, and you create problems. That's the same thing with we're talking about the supply chain. I mean, same kind of deal. People weren't working. It causes, just ramifications that trickle down that take time to recover. And I think that the Fed and a lot of people thought it was just transitory. It would quickly kind of erase itself and fix itself, but that's not been the case. It's more complicated than that, especially when you add in that war that we talk about with Russia, Ukraine, you add in China doing additional COVID lockdowns. All that has ramifications, to your point, to that global supply chain. In this article here, they talk about why we think inflation should ultimately peak this year. And it talks about several reasons. First, monetary and fiscal policy are in the process of being tightened. The problem is you mentioned QE, now we're going into quantitative tightening, and generally the markets, haven't behaved very well when we go through the QT versus QE, right? So you've got a perfect storm with higher rates, with inflation, with all these different things. But you look at hourly earnings up 5.2% in May, while consumer prices up 8.6% from that CPI. So these factors are expected to weaken pressure on prices. In addition, assuming the war, we talk about the reverse wealth effect too. You take your 401k and it's got $1 million, and now it's only got 600K. You might change your psychology on how you're going to spend your money. You might, instead of going on that trip to Italy, that's 5 or 10 grand, maybe you're doing something that's way less, that's local in the US, and saving some money. That there are definitely ramifications there that are going to bring some of these prices down as well. And all that has trickle effects. You think of economics, my undergrad was international business. And this was 20 years ago when the business was, when you think about the world, it wasn't a global economy in the sense it is now. You think of 20 years ago, late 1990s, it's evolved. To your point earlier, it's much more of a global economy. And, then I got a master's in MBA, focused more on the economic side and sustainability side. And it's just, as someone that studied, I'm not an economist necessarily, but studies, the economy and in economics, this is about as perfect of a storm that you can create, and it's going to cause impacts to the market. And then on top of it, you had the market at all-time highs, and there was areas like speculative assets like ARK and crypto and all these different, even hyper growth stocks that were just way into the stratosphere, way higher than they should have been. And so people are buying the top and complaining how the market's doing really bad. But the reality is we kind of had this whoop up and this whoop down. We've kind of just erased that period. The market's trying to erase that whole period and go back to around pandemic or post-pandemic, pre-pandemic, and a lot of these prices. When you think of cloud stocks, kind of go back to the mean, so to speak, right? So the question is, how much further do we have to go? How long is this going to last? How do I manage my portfolio? And so people get scared. They go to cash. They sit on the sidelines. And that's not always, the best way to go about it. So
I don't think so either, man. And so there's two things that I got to say about that when it comes down to like managing our portfolios. Number one is that even Deloitte doesn't know this. And I don't think that many economists know this. And I don't think that a lot of people that I follow, like Lynn Alden, like Richard Duncan, a lot of the famous, really, really great economists, people that are just very, very bright. Like they're probably borderline genius in many of their own in their own respects. But the question really becomes, after the COVID-19 pandemic, did this become structural or is this cyclical, right? That's the question. Because remember how I mentioned before, how in 2008, when we were in a deflationary environment for so long, and we were able to print out a bunch of money, but that was because of the structural forces of like the structural deflationary forces between technological innovation, globalization, many, many different things like that. I can't name them all up, like debt too. That's another big one. Are we heading into a new norm? Like, is this really going to be World War III? Because if it is World War III, then we should expect to see some sort of structural inflation, right? Which would be, obviously, I don't think that inflation would be the most of our concerns if it was World War III, right?
Right.
But, or even our portfolios for that fact. So what it really comes down to is like, okay, when we look back at history, 100+ years, and we backdate this, and we just ask ourselves one simple question: how many times have we been here? It's a lot. Right? 1920s, in the late 1990s, so it was like 1916 to 1920, there was a hyperinflationary environment after World War I, right? Mm-hmm. And then you ended up seeing this massive inflationary boom and bust, right? And then it was actually a depression. That's what a lot of people don't know, is that that's the overlooked depression in the early 1900s. Same thing that ended up happening in the 1940s, actually. And that Lynn Alden, I've read one of her pieces the other day. She was comparing today's environment much like the 1940s, because in the 1940s, the government printed a bunch of money. We had to win the war. But what we ended up seeing was an inflationary period. But because debt levels were so high, much like today, what ended up happening is you had to really go through like this Weird structural productivity reset. Because you had to devalue the debt. The government had to devalue the debt through inflation, which is pretty much what's going on right now. And that what you're going to end up getting is you're going to get years and years and years of productivity if history rhymes. Right. It is not like 1970s, where a lot of people just automatically want to assume 1970s inflation. I mean, sure, there's going to be comparisons, but when you think about the COVID-19 response was very, very similar to a wartime period. Yeah. Right. So like, is this structural? Is it cyclical? And how do we really manage our portfolios at the end of the day? Right. Well, I don't know about you, and I think that we're seeing the same thing, that a lot of people are trying to jump on this oil and gas train, and a lot of people are going to get rug pulled, because we can watch stocks like Datadog, Snowflake, Zscaler, which was, that was one of the most bullish calls I saw. And even like SentinelOne, CrowdStrike, you listen to these earnings calls and the CEO is like, yeah, we're not seeing anything. No, there's nothing going on. Like, we don't know what everyone else is dealing with, but our business is better than ever. We're actually hiring right now, and we're accelerating. We're accelerating our revenue. And it's like, and people just want to completely overlook this. Yeah. And cybersecurity makes sense, especially with the Russia, threats, and most of those stocks are kind of in that realm. So when you look at it, I started investing in the late 1990s as I was in college. So I went through the .com. Of course, I didn't have a ton of money invested in the market, but the very first stock I ever invested in was a spec stock. It was like a penny stock, and it went to zero. And I tell the story all the time. It's like, I've made mistakes along the way. Part of the reason I'm doing this is that
I've achieved, multi-millionaire status, and I want to kind of share my journey because I made so many freaking mistakes that it's like, I know I can help people that are watching this at least avoid a couple of those stupid mistakes I made. When you think about back then, we didn't have the ability to talk on Zoom with other investors and share strategies. We didn't have the ability to talk on Twitter or have YouTube. None of that stuff existed. And a lot of younger people don't understand. Like, I didn't even have a cell phone. I had to go to the library and read microfiche of Wall Street Journal that was 3 days old if I wanted to research stocks. Now we can go on to any investor relations page. We can, pull up all the information, the 10Q, everything is right there at our fingertips. You can go to the SEC's website, pull stuff up, all right there. Everybody's got tons of opinions. You're getting information overload. Who do you listen to? So there's not a lot of people that I collaborate with, other channels and things like that. And you're one where I feel like we're aligned on what we're thinking, when we think about our portfolios and the macro. And so I'm happy to have you on the channel here, but, looking at this consumer sentiment, you look at University of Michigan, it went to the lowest level in history. It says half respondents basically, talk about inflation came into the levels reached in 1980 when we're in the midst of a recession. And you think about a year ago, everybody was on cloud nine thinking that everything was rosy, and it just turned like that. I mean, I don't know if I've seen anything quite like it. 2008, that whole, Great Recession, that was unique in itself. But you're talking about financial institutions, banking institutions crumbling. That's a very different scenario than what we have right now. And I think a lot of people don't understand that. And you think of .com bubble, you think of the ARK, the speculative, highly speculative assets like ARK and crypto. Those were in bubbles that were very similar to .com. In fact, if you look at some charts, some of those areas were even worse than they were in .com. But people try to compare the NASDAQ and all stocks to the NASDAQ and say it's this bubble. I mean, Google's trading at what, a 19P ratio? Is Google a bad company? Should it have a better valuation or higher valuation or premium?
Look at the balance sheet, man.
Yeah, right. So you look at it, it's like, okay, we raised 75 basis points. Now mortgage rates have basically doubled, which I think a lot of people, I was in real estate for a while, and a lot of people don't understand the ramifications of that. When all the houses are going higher and higher in price, and all of a sudden, you can barely afford houses based on your debt to income because the rates are low, and the rates double. Now you're getting forced out of houses that you can't afford. And you think of, buyers and sellers, it's a market. You try to sell a house, you got to, have buyers. Now, a lot of the buyers that could buy your house before actually can't qualify. And so it becomes from a seller's market to more of a buyer's market. And that's going to have effects too. And who knows how long that's going to take to flush out the system. I can't tell you if it's going to be really bad or not. Maybe it's not as bad as some people are saying, but you have to at least understand that if your mortgage payment goes up 50%, that's going to impact the ability for some people to buy homes. It also is going to impact disposable income. You think of, even if your rent goes up and you're not buying a house, if you only have $500 a month of disposable income and all your gas prices and your rent and everything else goes up, and now you only have $100 a month of disposable income, well, that's going to affect things like Starbucks and all of the consumer discretionary type companies. And that's going to have effects too. What does that look like? Consumer sentiment being this bad is definitely something to pay attention to. But to your point, I'm not going out and buying e-commerce stocks right now. I'm focused on cybersecurity, enterprise, best of breed type companies where they're mission critical. Like, companies need these to succeed, whether the market's good, bad, or indifferent. You're not going to cancel your Zscaler, subscription if you're a business, if you're a CIO, because you need it, whether the economy is good or bad. And a lot of these stocks that we talk about become even more important in bad environments because, some of these actually can replace the human element. You think of artificial intelligence, you think of, just worker productivity and efficiency. So, we can go on and on about that, but yeah.
So I like how you bring that up. I really think that where FinTwit, because I spend a lot of my time on FinTwit. I know you're both FinTwit and YouTube and Discord.
And TikTok.
Yeah, and TikTok. So you're all over the place. I spend a lot of my time on Twitter, and I get to see at least probably 20 or 25 bad takes a day. And the reason I'm so sorry about that, but honestly, and even like YouTubers sometimes, this is the reason why, is because no one is ever really asking why. Like, why are we just destined to go down the way we did in 2008? Right? Like, I'm not sure if you've seen people compare the charts to 2008 to now.
Where it starts, and it's like, we're here now, and it goes this
like,
far.
Dude, the banking system was collapsing. That was 1929. We were literally looking at the next Great Depression, and we have inflation right now. Like, I understand the economy is not good, but the federal funds rate's like 1.6% right now. It was like 7, what was it, 7% back then in those days?
Yeah.
It was somewhere around there. But the moral of the story, what I'm trying to say, is that we got to understand like why and like what's going on beneath the surface, because a lot of people look at a chart and they say, well, this chart looks like this chart, so therefore this chart must follow this chart, right? But I don't know a single trader in my life that has ever been profitable following that specific strategy, where they say like, hey, the ones that are really, really smart understand what is going on beneath the surface of the individual businesses, let alone the stock market as a whole. Right. So like when you do take a look at the forward PE, realistically, like we probably have, if we were to bottom, realistically, on a historical basis, our forward PE on the S&P 500 should probably be somewhere around 12 to 13 on a forward basis, which is going to put us roughly at like a 16, 17, maybe 15 trailing 12-month PE on the S&P 500. And this is very, very healthy. This is a very, very healthy PE. And even on the NASDAQ, when somebody wants to pull up the NASDAQ and say, this is where we are in the massive bubble, and it's just kind of like, you know what, I understand where you're coming from, but the 1999 NASDAQ was structurally similar to the ARK K Innovation ETF, where you got a bunch of crap, right? You got a bunch of unprofitable companies, highly speculative companies that are not even profitable, biotechs in this particular case, and then a lot of like stay-at-home stocks. I guess that was the coin, or that was the term back in those days. So the ARK K Innovation ETF and then the NASDAQ was very, very similar. And even if you compare those apples to apples, put them on top of each other, the damage has already been done.
Yeah.
The damage has already been done. The speculation, the bubble, it's gone. And that's what a lot of people don't, because they're not looking underneath the surface. They're thinking to themselves. So if somebody can sit there and actually tell me that Google deserves to be trading at a forward PE of 10, which is less than Costco, which is less than Pepsi and less than Coca-Cola, then I'll actually listen to them. If they can come up with a legitimate argument as to why a 25% growth company that's specializing in artificial intelligence, search engines, that's never, ever going to go away, and then even autonomous driving, why should they trade at a less of a valuation? And their balance sheet is even better. They have no debt.
Yeah.
And their cash flow is phenomenal. And they got stock buybacks.
Yeah.
And it's like, there's nothing that makes sense.
Which doesn't doesn't change the fundamentals at all, but a lot of times it'll
think that's the word that I'm looking for.
Stock have a little bit of pin action, but yeah, with the ARK, I mean, we might not agree on this part of it, but I believe there are companies in ARK that will do well, but they are highly speculative and they don't have, the cash flows and the balance sheets that are needed in a recessionary type environment. And those are going to get whacked, without free cash flow, without any kind of path of profitability whatsoever. And there's a lot of good ones. There's a lot of bad ones. And the problem with any ETF, no matter what ETF it is, all of them are going to have their bad apples within it, which is why a lot of people like to invest in individual stocks, because you can just have the stocks you want to own and not the basket, which has the good and the bad. And with ARK, there's definitely, some stocks in there that I personally wouldn't buy, but I also own some of the stocks that are in there that I think, can do well. But yeah, and I mentioned that earlier too. I think, the .com bubble would be similar to a lot of the crypto, especially the altcoins, stable coins, and ARK. And a lot of people just don't realize that. You see jokes once in a while, like, this is going to be the worst crash in the history of the stock market. Jimbo investors since 2019 or whatever, born in 2015 or, whatever, like they haven't even been through, these market ups and downs. And I get people on TikTok or even on YouTube or whatever, telling me I'm wrong and that I've never been through anything like this. And I'm like, well, I've been to everything since the 1990s, .com bubble, 2008, 2009, 2018. There's 6 other events in there if you really want to add them up. The 2020 pandemic sell-off. There's been a lot of bad times over that 20 years. And then people like to say, well, if you bought the NASDAQ in 2000, it took 14 years to break even. Well, nobody invests statically. You don't just throw all your money in and never put another dime in. Most people that are investing are working. Every time you get a paycheck, you're buying. So if you have conviction and you're investing, that's how you accumulate wealth, is those 14 years that it took. You're buying that whole way and accumulating a massive amount of wealth when it gets to that next bull run. And we could be in a phase like this. It could take 6 months. It could take 2 years. We don't really know for sure. I mean, we can try to speculate and we can try to be optimists, but we could accumulate for a long time. But we know, as people that have time on our side, that eventually it's going to get to that bull run, and our money's going to be made in these downturns, not in the bull runs, in the bear runs. That's where we make our money.
I want to build on top of what you just said, because I know that there's going to be people out there that are thinking to themselves, but what about the Fed, right? But what about the Fed and the Fed pivot? What does history suggest, right? And don't get me wrong, I actually published a Substack on this one time that said that the markets, the indexes, literally follow what the Federal Reserve is going to do next. Yeah. But if you backdate this, if you backdate three stocks, not two stocks, sorry, three stocks, Apple, Amazon, and Microsoft, which is today's big winners since that 99 bubble, right? Apple bottomed in 2000, December of 2000. Amazon bottomed in 2001, and Microsoft bottomed in 2000 as well. I think it was December, no, 2001, I'm sorry, 2001, which was 2 years before the NASDAQ and the S&P 500 bottomed, because they bottomed in late 2002, early 2003. That's when you actually saw that double bottom. So when people are, and want to know what the even craziest thing is that Amazon was actually trading higher at that bottom. So when they bottomed in 2001, they were actually higher when the NASDAQ and the S&P 500 bottomed. Yeah. So when people want to say that, like, this is what the index traded at, therefore you're going to never have your returns back. If you buy the indexes, and that's what I think is the risk, the hidden risk of index investing, is that when you buy the indexes, and I'm not advocating against ETFs, because I do think that ETFs are phenomenal, like having some SPY or some QQQ or even some like SKYY. I think that those are really great investments. Mm-hmm. But if you actually, I totally lost track what I was going to say. No, if you stock pick, those individual businesses are assets. And that's what Peter Lynch, I think that Peter Lynch said something that was so important, that what a lot of people don't think about is that these individual little ticker symbols that have numbers right next to them that flash red and green every single day. Right. Those are businesses with business equity, with generating cash flows, fundamentals. And a lot of these businesses, like for example, right now, Datadog, like a lot of people are just looking at it. Oh, it's trading at a 13x forward price to sales. Well, they don't know that it has 25% free cash flow margin, and it's growing 80% year over year. You know, and like that's what a lot of people are just completely overlooking, is that even though these stocks may tick down another 5 to 10%, it's nothing more than an opportunity right now, because the underlying asset is the business is continuing to improve. So the index may take another 2 years to recover from here. Right. But I do think that Datadog, Zscaler, like especially Datadog, I think that they're going to recover back to their all-time highs. I honestly do.
I mean, and that's something I tell the community often is, think of investing in stocks as pieces of a business. And I also use the analogy of, like, if you own a house, and it's not the best analogy now because you can go on a Zillow and get an estimate, but like you think without that, it doesn't have a ticker that's just floating above the house. Every time you leave the house, you drive out of the garage. Oh, I lost 10% of my house value today, and you're not checking your Zillow on your house every 5 minutes. But people that have stocks, there's literally people, they sit there on their app, on their Robinhood app or their Fidelity app, and they check every 5 minutes. They're just sitting there staring at their portfolio thinking that this is going to make them rich overnight. And it's not, and that's something you have to kind of train yourself. Like, hey, you set up limit orders, you set up alerts, but if you're still working, like, you shouldn't just be staring at your portfolio, let it impact your life. These are businesses. And if you're owning them for the long haul, if they're quality businesses, the stock price will work itself out. You talked about Bezos, or you talked about Amazon. When back in that whole .com crash, the stock got absolutely just hammered. And there's several stories about this, and they're really funny. But one of them was an interview, and he basically said, is the business broken, or is the stock broken? You know, it's like the stock is broken, but the business is going to prevail. And, you know, it's cool to look back at that because he was right. Because for every Bezos, there was 10 others that said the same thing that no one even knows who they are because they went out of business in that time. And, you know, the same kind of deal. You're going to have some of these unprofitable SPACs that will probably go out of business. We've actually saw our first one, I think, last week, a name I wasn't familiar with that did go bankrupt. Some of these, you know, stable coins, you got Luna and some of these that are kind of just folding.
Stay away from that.
You're going to see more of that stuff though. You know, that this is like the .com bubble 2.0, 20 years later. And the crazy thing about markets, history loves to repeat itself, and humans, we're creatures of habit. And this is why, if you understand that psychology to Morgan Housel, like if you understand your brain and how you're wired, long-term investing is an easy game to win. It's just that you have to have the psychology and discipline that most people can't have. And it's funny because you think about the people that I know that are really good investors, they have something in their history, in their past, that have made them that way. For example, I had a VIP call a couple of weeks ago. One of our members was a Navy SEAL for 8 years. You know, he's got discipline the average person.
I was a Marine.
You were a Marine, right?
Yeah.
I wasn't in the military. You know, thanks for your service, much respect. I played sports, which is not the same, but I played college level sports and, you know, had a good career. But that did give me, you know, change me at my core with discipline. Because if I did something wrong, my whole team, 100 teammates had to run while I sat there and watched them, you know, until someone threw up. You know, that was the kind of punishment we had, you know. So it definitely is not the same, but it did instill those same values in me to have that discipline and think of something bigger than just yourself, being part of a team, you know. And that's why, you know, a lot of the investors you see, they have that foundational discipline or psychology. They understand themselves better than the average person. And that's probably the biggest key to successful investing that a lot of people just overlook entirely. So,
man, I love that you said this. And this is why I relate so much to you, because we were both sales guys, right? And pretty successful. And I'm still a sales guy, and I'm 31 and I'm doing very well for myself at the moment. And I love what somebody said. I don't know who it was, but they said your job, your career, your business, the thing that's producing cash flow is what will make you rich. Your investments make you wealthy. Yeah. And being able to distinguish the difference, because there's so many people, and I know we see it every single day, whether it's YouTube, TikTok, and you see it's even on Instagram right now, on Twitter, and everyone's just trying to take money from the markets. That's what they're trying to do. They're trying to get rich from the markets, but they don't understand that, like, okay, so let's even like break down the math, dude. I made this tweet the other day. Let's say we have a $200,000 portfolio and we run 20% annualized returns, right? So if you get 20% returns on your $200,000 portfolio trading, because even though some people may say, like, if you just win on every single trade of every single day, well, that's not how that works. Because it's one big loss, then all of a sudden they lose their gains for that month, right? That's how trading realistically is. They have wins, they have losses. If you win 50% of the time, you're doing good. But if you realize 20% returns with a $200,000 portfolio, that's $40,000 in short-term gains, right? With those short-term gains, you're going to be taxed at about 25 to 30%. What you're going to end up having after that is like $27,000. Yeah. Did you really make that much money? No. Unless if you were investing, if you were doing quality investing, then what you would have at the end of the year is you would have $240,000 plus you just advanced in your career or in your business, which is also an asset in its own. And then that also is going to start producing more income, and you still have $240,000. You don't need to cover your living expenses.
And
Sorry, did you say that?
Thanks, Siri.
And it can compound, right? I mean, trading is not necessarily going to compound, and it's two different mindsets. Now, what's interesting that a lot of people don't know about me, I think the Discord community does, is that I was a trader, a day trader for a long time, and I still do it occasionally, but not very often. But I don't talk about it and I don't teach it because I'll tell you that 90% or more fail. And I'll tell you that when I started, I had failures as well. I did tons of paper trading, and I really have 3 strategies that work for me. And I only do them if I know, if I think there's a really high chance they're going to work. And it's like one of those things, you can't force it. Either that setup's there and you take that setup, or you pass. And that comes back again to discipline. The discipline for trading is even probably more important than the investing in some ways, because you have to be able to like admit you're wrong and take a loss right away. Because if you can't bag hold when you're day trading means you're basically closing out all of your holdings every single day. You're not holding anything overnight ever.
Yep.
Okay. So options traders really aren't day traders. They're more swing traders. So they're usually doing 1 week or, 1 month or whatever.
And gamblers.
And there are some people that make money, but the statistics are really bad. The people that share their wins, they generally are sharing their wins and not their losses. And I've read a lot about this. I have a whole nother community that I've been involved with for years that's focused on trading. And I'll tell you that most people should focus on long-term investing, because it's a dead end. For me, it's more of a hobby. And I've said this before, I have a separate account that's 1% of my net worth. And it's not the end of the world if I lose that. The problem is most traders, they take their whole net worth and they gamble it like Vegas style, trying to get rich quick.
Yep.
What I do is completely different. I might do $1,000 or $2,000 trade here and there. If I lose a few $100, stop loss, no big deal. That's not going to hurt me at all. And it's mostly for fun. It's not, I'm not trying to get rich off it. I think I can make a few bucks, but there's 250 trading days in a year. So if you're a trader, you're looking at it like, okay, I need to make, so if you make $100 a day profit, 25,000, so you use, those are the metrics you're using. And then you can say, well, there's 250 trading days a year, but I'm not going to trade every day. So you might only trade 200 days, and you do the math. Most of the traders I know that are successful, they're wealthy from investing, and they trade on the side as a hobby, retirement, or for fun. I don't know a single person that's made their living or their wealth, to your point, from trading. Nobody. They all made their wealth from investing. And to your point, you can't just sit on your butt and not have any income and just put $10 in Robinhood and think you're going to get wealthy either. You're going to have to put some work into it and invest some coin if you're going to want to get true wealth and become a millionaire. You're not just going to, you can look at those. Oh, if I invest $100, for 30 years into a VOO, yes. But if you really want to make moves, you're going to have to figure out how to make more money, how to spend less money, save more of it, and invest. Otherwise, you're going to be working to 65 and 70 like everybody else if you can't figure out how to do that.
I always tell, so my Discord community is a lot smaller than yours, because I really do focus on my Substack. I like to tweet my thoughts, and I like to tweet my research and post my research on my Substack, because honestly, and I say this to everybody, 80% of my mind, 80% of my time and my energy goes towards producing more cash flow.
Right.
That's all I think about every single day. Like, how can I produce more cash? Because I'm in sales, right? So I need to figure out how I'm going to sell this, how I'm going to sell that, how I'm going to make sure that I'm meeting the boss's expectations, right? That's where I'm at right now. And I'm in medical sales. So you can imagine that, I do pretty well for myself in that particular case, but I have a lot of expectations of me. 80% of my day is focused on that. And the other 20% is focused on how do I take what I've had over here and how do I preserve what I've made. Yeah. So it's like I'm going out there and I'm hunting every single day, right? Yeah. And think about it like if we were like very primitive and we were out there, we were like caribou hunting or something like that. You take the meat and you store it, and then the more meat that you store, the more meat that you store, and it's kind of like that's what it would be like from a primitive perspective. But like now, it's like I gather my nuts, but I'm finding ways to have my nuts make me more nuts. Yeah. Right? That's essentially what investing is that I take all this money from the economy by contributing to it, by finding a way to be productive to it. And that in itself is an asset. I'm an asset. I'm an asset to my financial statement, right? And then you take that and then you store it. And then realistically, if you buy good businesses and if you focus on the business long-term and ignore the flashy lights and ignore the numbers moving up and down and ignore everybody saying, don't buy the dip, don't buy the dip. It's like, AMD is trading at a forward PE of 19 right now. Are you kidding me? I'm going to buy that dip. Right.
Yeah.
Like you're out of your dang mind. I'm going to put another $150 in there tomorrow. Yeah. Right. Because I made a couple bucks and I'm like, yeah, of course I'm going to buy that dip. Actually, it's 160 because it's $82 a share, $81 a share. But you know what I'm trying to say.
Yeah. Yeah. No, I mean,
it's like,
we're
the mentality is different.
Yeah, the mentality totally different. We're basically, I'm just in a different stage. So like I'm 10 years older than you, and I was in the exact same situation as you. And so now I'm spending 100% of my time. This is my job. Like I'm trying to educate people on how to grow wealth and
how you did what you did.
And I here's the thing. I left a 150K base plus commission job in SaaS, which is a lot.
Yeah.
And, I look at that and it's like, well, and I wrote about this recently on Substack. It's like, I certainly am not done contributing, but I'm contributing in a different way. I'm contributing this way. And, I'm not making nearly as much money by doing this, but if I can help people, that's more important at this point in my life than that accumulation phase. So I'm still in accumulation phase, but now I've got enough assets that can accumulate for me. If I can make a few bucks doing this, I put all of it, either back into the business or into the portfolio. And I'm just trying to invest for a 2030 time horizon and trying to grow the portfolio. But to your point, you put enough of those nuts away, it grows into more nuts. Eventually, you're going to have so much wealth that wealth can generate passive income where you don't necessarily have to have that job if you don't want to. Now, a lot of people get it twisted with financial independence, retire early. Fired up wealth is financial independence, retire early with dividends. So you're taking like growth, you outperform, you sell growth, profits, you convert into blue chip dividend stocks, passive income, and you can have financial freedom. But where people get it twisted is they're like, oh, well, I don't want to retire at 40 or 50 years old because I'll be bored. Like we're not talking, I'm in Fired now and I have a business, Fired Up Wealth, but I got to a point where I had the financial flexibility to say, this is what I want to do now, instead of working this other job, which paid well, but had lots of pressure and expectations. Now I'm my own boss. And I feel like I'm contributing back to society more than I was just selling software to businesses or whatever. Right. So it gives you that freedom, financial freedom. It doesn't mean necessarily retire early. Financial freedom, do what the heck you want. You spend more time with your friends and family, travel, start a business, but you have flexibility and you don't have that pressure of like, if I don't go make a bunch of money today, I can't pay my bills or I can't live or can't survive. When I was in my 20s, it was survival mode, like scraping by. How do I pay my mortgage? And then you slowly find yourself. And the key is to not, a lot of people make more and they spend more. You keep the same lifestyle and find a way to make more money and save more money and not spend more. And then you slowly grow that wealth in your 30s. And if you do it right and you get to a bull market, 10 years from now or 12 years from now, however older I am than you're going to be in the exact same scenario I am and have the flexibility to continue your medical sales job if you want, or something else. Maybe you're doing, you're doing Blue Suit full time. Who knows? Right.
Yeah, man. And this is the cool thing too, is that I've heard you say this because I'm one of your viewers. Right. And I was one of your viewers, and that's why. So I had a bigger Twitter. I used to. Now you surpassed me. But I used to have a bigger Twitter audience. But I remember I watched you on YouTube all the time, and I'm just like, see, this is the right way to do it. This is what people need to be hearing. They need to be hearing like, hey, realistically, like I don't think that what I do with my portfolio, I really don't think that people should be doing with their portfolio. I'm not saying, and the reason why I'm saying that is because it's very volatile. It goes like it just flies all over the place because it's individual stocks. And I hyper focus on the businesses. I know the ins and the outs. I know all the financial statements. I know what the CEO's name is. I know what the CFO's name is, right? So like that's where I really try to focus in on. The index investing is very, very important, right? It's important because it provides that stability, that just constant up and up. But I think that I'm just more or less validating what you're saying because it's really interesting to see you and your perspective having the same thoughts and the same process and the same mindset. And you have reached the ultimate goal that we're all trying to reach, right? We're all like, I know a lot of your viewers are probably my age, and all of us are all trying to think the same thing. Like, how do I get to be like Eric? How do I get to be like multimillionaire? How do I get to be a business owner? How do I get to make sure, and you don't necessarily need to talk stocks all day. That's kind of what you found passion in. But, you could also own various different businesses. You can also be partial investor into like restaurants. You can also be partial owner into, I know that me and my wife were talking about a caribou cabin, those little caribou shacks, because she wants to manage a couple of those. Real estate investing as well. All of those things. So it's like the philosophy of getting rich is only achieved through long-term discipline and making the right choices over time. And it's not a get rich quick. It's not Dogecoin. Those people that became millionaires were literally won the lottery, and I would be surprised if they're actually still rich, honestly.
And the big thing, the big thing that too is the plan. Like you think of like the Marines or, football game or whatever, whatever it is, you're going to have a plan, you're going to have a strategy, you're going to have tactics to make it happen. And a lot of people, when they think I'm going to invest, they get a Robinhood account and they just start buying stocks. I'm an investor and I have a portfolio. You don't have a portfolio. You don't have a plan. Like, what's your portfolio to own every hyper? Why don't you just buy ARK? Like, what's your plan with your portfolio? So like one thing for me is like build a blueprint, like a house. Like, so ETFs, they're good and bad, but they give you a little bit of core. And maybe it's only 10% of your portfolio, but it gives you a little something. No matter what, you never have to worry about VU. You can always add to it. You can sleep well at night knowing in 20 years it's probably going to be higher. And if it's not, well, there's probably bigger problems in the world to worry about, right? Zombie apocalypse or something. and then you got the dividend stocks. So the DGIF, we focus on dividend growth invested for fired, where it's like, I'm not talking about buying Coca-Cola. I'm talking about like a tractor supply company that still has growth that isn't crazy expensive, where the dividend's going to grow. It's going to accumulate like Microsoft did when I bought it in 2012. And now it's this behemoth. Now my cost basis on it, I think I paid $32 and I've got a 6.5% yield on cost. I'm getting a 6.5% yield on cost on Microsoft, and it's growing at 30%. Those are the companies you're trying to find in that DGIF pillar, and then you got your growth stocks. So like all the stuff we love to talk about, because that's what's flashy. That's what's going to make us rich quick. Well, if you have all growth stocks, to your point, some people can stomach that. The average investor can't, because it's too up and down. There's too much beta. And so you can balance that out to whatever meets your needs or suitability. And everybody's going to be different. That's why I like to have those blueprints and kind of build out a plan. And even you have a plan. Like you're not just going all in on fintech. You're diversifying into different industries. You got a plan of what secular growth trends you're going after. It might be different than the other guy's portfolio plan, but you have a vision or plan of how it's going to get to where you want to be with your goals. And a lot of people
literally have price targets on my stocks. Yeah. Like I did 2025 price targets on my stocks based on historically mean valuations, where I think, and I even use Wall Street analyst estimates just to be unbiased from my perspective. Like, okay, if Snowflake ends up trading at a 15 trailing 12-month price to sales, realistically, they should be trading at about $300 per share, right? That's trailing 12 month. And that's based on analyst estimates, and that's conservative estimates, right? That's the way that I really take.
Absolutely.
I didn't want to interrupt you.
No. It's absolutely. It's just like the whole plan thing, though. Like people overlook that blueprint of that plan, and not just your portfolio, but like why are you investing in the first place? What's your why? Like why are you doing it? Well, to make money. What seriously? Why are you investing? What are you trying to accomplish? Because if you don't really have a plan, you might as well just go blow it on something stupid anyway. Because if you don't have a plan, once something hits the fan, so to speak, you're just going to dump your portfolio. And people will say all the time, like, "Oh, do you ever use money from your portfolio, like your taxable brokerage, to go on vacation?" Like, no. If I don't have the money, I'm not going to sell assets to go on vacation. Like, no, it doesn't work that way. It's because my plan won't allow it. The discipline, the plan. Like I've got a plan right now. The portfolio needs to grow to $5 million by 2030. That's just the taxable brokerage, no retirement accounts, no business assets, nothing else, just the one brokerage that I always talk about on the channel. When I get to that point, it'll be slowly evolving into more of a passive income account. And I want that to pay between 100 to 150,000 a year in passive income, right? And that's kind of my end game. Everybody's got their own number end game. And I've got the macro goals and I've got the micro goals. My wife and I, we meet every quarter and we have all our goals written down for quarterly goals, yearly goals, 2-year, 5-year, 10-year, and so on. Everything from where we want to travel in the next 5 years to financial goals, house goals, goals for the kids. And we hold ourselves accountable to those goals. And it might sound silly, but you're way more productive if you write stuff down, you hold yourself accountable. And a lot of people listen to this like, well, that sounds like a great idea. Why don't I do that? Why don't I have a plan for my life? you're investing in these companies, expecting them to have a business plan of how they're going to achieve profitability or achieve this much growth. Why wouldn't you have the same expectations for yourself? Have your own business plan on how you're going to get to where you need to be. And not enough people treat their lives as, it's kind of like a business in itself, which a lot of people don't want to think it that way. But if you treat your life like a business, it's going to allow you to have that flexibility in those later years because you knew how to get to the end game, so that's my take.
When we think about portfolio management too, so if we can take that planning and apply it to portfolio management, there's two big things that I end up seeing a lot of investors make a mistake of, especially retail traders: margin and options, right? When you set your goals for your portfolio over time, a lot of people get super, super excited when stocks go up. And I think that we saw that the most in 2020 and 2021, because I don't know about you, man, but I saw 2020 and I was like, how in the world is this thing going up? I didn't understand macro the way that I did right now. And that's really where I understood it, because you go through it and you kind of stand back and on, you're like, wow, this Fed thing is actually a big deal. If they're printing $120 billion a month, like they can pull us out of the coronavirus thing like this. That was crazy. But I saw a lot of traders do there was an options trader that I once knew. I'm not going to name him. He quit his job and he grew his account from like 20,000 to 300,000. I don't know what he's doing anymore, because he's not posting on Twitter anymore and he's not a trader anymore.
Probably lost it all, margin.
He probably lost all. Yeah. All on margin, all on options and things like that too.
Never borrow money to invest in anything. People get this thing like, well, it's only, I can do a 0% cash advance and, or it's only 2%. Like, I'm going to take this personal loan at 5% because I can get 10% in the market. You're going to lose. If you don't lose the first time, you're going to do it again because you're going to get cocky and eventually you're going to get burned every time. And I've been there too. I've made my own mistakes to tell you that it's a fact. I've been there myself and can tell you from experience, don't do that.
Early 2021 is when I learned my experience.
Yeah. I mean,
that's when I was just like, holy crap, no more money.
Yeah. No, I didn't do that. I didn't do recently, but I would say that 2021 and 2020, the Fed actually blinded me, because people would say, well, this is so frothy. And it's like, yeah, but we've never had $2 trillion of stimulus pumped into the economy. So I use that as a justification. And I did trim some stuff in like November, but now in hindsight, you look back, you just want to slap yourself. Like, I'm not saying you should sell your portfolio. And this is the problem. Like, if you're a long-term investor, like, you have to get into the mindset, like, you're not just going to liquefy. If you're a trader, like, oh, you should have sold in November and then bought it back. And it's like, this is where traders and investors are like oil and water. But smart investors still trim. One of my top 15 investing rules is take profits, take some profits, trim some profits, 10 or 15% when it's frothy. Well, if I follow my own rule, and I did some of that with Cloudflare and a few names, but in hindsight, I should have done a lot more of it. And I got cocky, and I tell my community this all the time. I thought we'd have that Santa Claus extension and we'd have January and February, and I was going to sell a bigger chunk, and it never happened. And sometimes that greed, the market's about fear and greed. And even the best investors and traders that have been doing a long time, you get blinded sometimes, especially when you get in unique circumstances that you have nothing to compare it to. We have nothing to compare this pandemic whirlwind to. It's never happened. So how do I compare it? How do I back to that? It's hard. And now you look in hindsight, like, well, duh, you should have done this. Well, yeah, but nobody knew it until it was too late. It was like this slow moving train wrecking that you could see, but you kept thinking, oh, it's only going to derail the first couple cars, not the whole train. And then it'd be the third and the fourth. Well, now you're already too deep. You're like, well, I'm not going to sell this stock here, even though it's going to go lower. And this is where people mess with their head. Like, are you an investor or are you a trader? Well, I don't want to panic sell, but I also don't want to, know when I know the stock's going to go down 30%, and you really start messing with your head. If you think long-term and you're thinking like, okay, I didn't trim some profits when it's frothy, I'm trying to add to my positions, highest conviction, and I'm thinking 10 years out, none of that stuff's going to matter if you have the right businesses. But our brains tell us fear of missing out, it's going to go higher. So 2021, November, let's buy Unity at $180 a share because it's Metaverse, and they bought Weta Workshop and they're going to the moon. And people, I didn't buy it at 180, but I was buying it at like 110, thinking it was not a bad price at 110. And then now it's a $30 stock, like And then you look at some of that stuff and you get blinded by these secular growth trends, by the FOMO. And then the other side of it's full fear of losing everything. When the market's going lower, we've already gone down 30, 40% on the NASDAQ. And it's like, well, what if it goes down 60%? We should sell here and then try to time it back in. And then your brain will just mess with you. If you just understand, like, it'll be fine if you have quality companies long-term. Yes, you're down 30, 40% of your portfolio. Think about it from my perspective. If you've got a couple $1 million and you lose 40%, that's a lot of money. Not everybody can handle that kind of paper loss. And, if you've been doing it long enough, you realize, like, hey, I look at what I own. To your point earlier, these are businesses. If I own a plumbing company and business slows down, I'm not just going to abandon my plumbing company because business slowed down a little bit. I'm going to figure out, I'm going to hold on to that business until it gets to the other side. Maybe that's a bad analogy, but you're owning a business, not just, we used to get actual stock certificates, and now it's just like this digital asset that it seems like it's almost like a game, like a video game. We've gamified trading and investing where it's like you click a button, now you own a share of Snowflake. Well, back in the day, you would have got a stock certificate you could hang on your wall. Those don't even exist anymore, So it's a different time for sure.
I came up with a saying: it's really, really hard to be bearish on a company that you're bullish on.
Yeah.
That's kind of what happened to me in November, is that I actually published a Substack saying the coming market crash, because I studied history and I said, man, I don't like the way this looks. It's got to go back to the 200-week moving average. And that's what historically has happened. And that was about 35% down from where we were currently at the NASDAQ. And I said, we may be screwed here. And I said, you know what? I'll deal with the 35% drawdown. That's fine. I'm just going to keep adding to my businesses because I'm young. It doesn't matter. I got a nice cash flow. We're good. And then all of a sudden, I didn't know my portfolio was actually going to end up trading with ARK, and it became so much worse. Like how you mentioned, fear or hindsight is always going to be 2020. But the truth is that when I see D-Local, like, that's one of my favorite companies. I saw D-Local and it was trading at like 50 forward price to sales. And I thought to myself, well, it's got 40% EBITDA margins. It's growing at 130% year over year. Of course, this makes sense, right? You price in the growth, it makes sense. And you actually try to validate this, and you even look at the cash position, you try to validate the business thesis. And when it starts going down, well, if you understand the business, you can't sell the business, mentally and psychologically, especially if you consider yourself as an investor and not a trader.
Right.
Like if you say, I'm here to buy good businesses. So that's why I hated 2020 and 2021 as a young investor. I was in full accumulation period during those timeframes.
Yeah.
But everything was in a bubble for a long time.
Yeah.
Everything was in a bubble.
Yeah. A lot of people were. And I was telling the community, like, we're going to have a correction in the NASDAQ in 2022. It could be a 15%, something like that. I certainly didn't think we were going to have, I didn't see having a bear market. I certainly didn't see, like, to your point, when stuff gets hit hard, like when Amazon's down 40%, D-Local is going to be down 60% and so on. And it's just this whole trickle down effect.
Facebook,
everything. If the price, everything becomes price earnings. If it doesn't have a PE of 19, it's too expensive. It doesn't matter if it has free cash flow of XYZ or this or that. None of it matters. Everything has to go back to the mean, and there's no logic. The algorithms and the markets just do their thing. And this is where you can make money, though, because you can sort through all the trash and find those diamonds that are thrown out with the bathwater, so to speak, and accumulate, knowing that, hey, the market's making a mistake on this. I'm buying it here. And it always seems hard to go against the grain, but those are always the best buys when you look back 5 years. And then you say, why didn't I buy more, D-Lo when it was whatever, $20 a share, but you start second guessing yourself too. Like, well, maybe I'm wrong because everybody else says I'm wrong. It's like, you're not, because you've done 100 hours of research on this company, but you're sitting there going like, maybe I don't buy more of this stock. And this is natural as an investor. You're going to have that no matter how disciplined or trained you are. Especially if you're on Twitter or social media, you're going to get influenced and pulled different ways that you don't want to be pulled. And this is one thing, like when you think of even like our YouTube community, we try to keep the consistent message here, Discord, it's very calming. Like, okay, yeah, this is a bad time, but like, it's not the end of the world and we're going to get through it. And everywhere else around you, even, CNBC, it's like the sky is falling, zombie apocalypse, whatever. And it's just really hard to go against the grain and be one of those few people that are like, yes, it's bad, but this is how I'm going to make money later. Nobody wants to think that way, And the people that always say like, oh, you should have sold in 2020, 21 in November and then bought it back. Nobody that ever tells you that has any money, and no one's ever, and they didn't do it themselves. It sounds
it's sold in March.
Yeah.
Or April or May.
Yeah. But you hear so many people, like there was this post on TikTok about this guy saying he could take $500,000 and double it in 2 years. And this was before the market got really bad. And I was like, no. And I did a poll, and we have a Facebook community. And I did a poll during 2021 when the market was like crazy. And I said, what are your expectations for annual returns for the next 10 years? What do you think that the average was? And this is firing up wealth. So like people that have been influenced by my YouTube channel for a good year in a poll, 10%, 15, 12, whatever. What do you think that most people said?
During that time, during 2021?
Yeah.
50%.
Oh yeah. 50, 100% a year, next 10 years. I'm like, you're going to double your money every year for the next decade. Easily. I just buy Bitcoin. It's Kathy Wood says it's going to $1 million and I'm good to go. I'm like, okay. You realize like 10%, you're probably outperforming over the long term. If you get like 12%, you're doing better than like 90% of most individual investors. I mean, most people can't beat the S&P 500. So you're telling me you're going to beat it by 5x every year for the rest of your career? Beat it by, double Peter Lynch's run that he had, which was historic and epic, that, it's almost impossible to even fathom people doing it in this kind of environment. And it's like the overconfidence effect, Morgan Housel again, right? Like, when everything's a bull market, everybody's a genius. And now
everybody's an idiot right now.
Everybody's a bear now. It's like, it's going to zero. It's going low. Every tweet, it's going lower. Oh, I could easily see 2,200 on the S&P by year end. Man, I mean,
Do you know how stupid oh my gosh, I'm sorry. Like the Bears, they had a time and a place 9 months ago. But when you sit there, and I see it every single day, all over YouTube, all over Twitter, more pain to come. I'm like, homie, the NASDAQ is down 30%. Like if you want to sit there and tell me that it's going to go lower than 2008 because we have a little bit of inflation, the Fed's tightening. I mean, I get it. We can really go all sorts of paranoid. We can say that we're losing our global financial system and everything is going to crap. We're going to World War III. Yeah, you can really dig that. I'll believe it when I see it. Right. But when the NASDAQ is down 30, 35%, and if you tell me there's more pain to come, I'm sitting there and I'm looking at you and I'm like, I didn't sell it before. I just bought more. I just bought more and I didn't listen to you. And I probably should have months ago.
Right.
But you're a little late to the party now. Like, where were you nine months ago? Like that's what I hate the most about this narrative that's going on, because it reminds me of the complete opposite of when everyone was running around buying EV SPACs.
Yeah.
Or when everyone was running around buying Dogecoin or buying Bitcoin and saying Bitcoin to 120,000. Even Tom Lee, man, CNBC contributor Tom Lee was even saying that Bitcoin was going to $100,000 by year end. And I'm just like, dude, even smart money got caught up in this.
Right.
Like, and now they're doing the exact same thing, but it's completely on the opposite end of things. I'm just not even listening to it, because I don't think that, frankly, I don't think anybody should listen to the herd anymore. If there's one thing that 2020 and 2021 taught us, is to never ever listen to them ever again, because they get way too excited at the top and they get way too pessimistic right at the bottom.
It's always yeah, I agree. It's always easy for me to not listen to the Bears, because I'm kind of just an eternal bull, because I know like long term it's going to work out.
Me too.
But I try to be very transparent and very vulnerable when I'm on my channel talking to my community. Like, I got caught up in the hype too, not as much as maybe a lot of other people did. And I certainly wasn't doing the clickbait and, I wasn't going all in and all that,
AMC
speculative stuff. Right. I wasn't doing all that, but some of the growth stocks, I even got blinded by it, just like this euphoric, like everything's going higher kind of a thing. And our community got impacted by it too. I like to think that we were never buying tops, but we were still buying things more expensive. And now in hindsight, it's easy to say that because you're in a bear market. But the reality is like nobody was calling for what happened exactly how it happened. Nobody was calling for it exactly. You might have said, oh, well, this is getting a little frothy. And I remember in Discord, like in November, it was like I had a $1.6 million portfolio like in October. And by November, it was like almost 1.9 million. It had gone up 300K. And every day it was like, oh, I'm up 50 grand today, new high. And I'm like, this feels like a blow off top. I don't know if you know what blow off top is, but
yeah,
it feels like it's a melt up and it's going to, and then it's like, well, but we got the Santa Claus rally and all this stuff is still good. We have the reopen trade in 2000. That's the thing that really blinded me. Like, well, we got the reopen trade. So like Airbnb and those kind of stocks, they're going to do well in 2022. And it's like, when the market turns over the other direction and smart money is selling and institutions are just selling at all costs, everything gets thrown out. It doesn't matter. There's no more thesis of why this company should do better. And now fundamentals don't even matter as much on some of these companies. It's just like, and what mattered fundamental for, say, a cloud stock, our expectations of those fundamentals were elevated too, right? Like, oh, well, we just get normal, like, 20 times, EV NCM, multiple. That's, it's Snowflake. That's okay because they're growing at 100% or Sentinel-1. It's growing. You start saying, oh, that's the norm. That's what these other ones are trading for. Well, the reality, they're all trading frothy and they get cut, in half. And it's like, hey, even the best. You think about venture capital and cloud, that stuff didn't exist until coming out of that 2008, 2009 Great Recession. So that whole VC run with cloud and everything was during a bull run. And you look at like the private equity venture capital right now, they're getting absolutely crushed. Like nobody's going public for a while out of the tech space, and the reality is that everything the valuations have been compressed, and there's no way to, if you're using cloud stocks as your gauge and you're saying, well, the median's this and the highest growth stocks are trading at these levels and those get cut in half. Did anybody call that? Do you know anybody was, even the best cloud people, you think Cloud of Judgment, was he saying that stocks are, cloud stocks are going to drop 60%? There's no way anybody could have known it was going to do that. And because you evaluate those stocks differently. Well, they're not a P ratio because they're recurring revenue. And it's like, and you start thinking about it, it's like when you really start getting under it, and I love these companies, venture capital creates their own magic formulas and numbers and rule 40s to justify valuations. Yeah. It's kind of smoke and mirror. You know what I mean? Like, yeah, these companies will grow into something great, but like there still has to be a maximum price you'll pay. Salesforce CRM, that stock did great things for investors and made them a ton of money. But over the last, you look at the chart of the last several years, hasn't done a whole lot because it had all this growth back here. So when you look at some of these stocks like Snowflake that you and I both like, they're already elevated in the private equity, venture capital. They get pumped through all the underwriting, Goldman Sachs, all the underwriters, all the institutions. They all put their hands in the pot. They all get first dibs. The Warren Buffett's the world gets first dibs. The accredited investors get first dibs. And the sloppy seconds when everything is, left over, that's the retail investor. And then not only that, when the IPO is going to open, it's like, well, we're going to open at 150, but then other institutions have the ability to buy it before it even opens again to retail. And by the time you and I can buy it on our Fidelity app, it's $400 a share. And then you're thinking, well, this is a great investment. Warren Buffett bought it. Yeah, but he bought it at $100 a share and you just bought it at 400 or whatever, but that's what that whole IPO SPAC, it was a bubble with money in the market flowing, everybody trying to get their payday. If you bought one of those IPOs, and I covered a lot of those IPOs, I bought a lot of those IPOs. I didn't buy the tops of any of them, But even like Upstart, you could have bought the damn thing at $50 thinking you're a genius. You went to 400. I'm a long-term investor. And now it's $35 or whatever.
Yeah. I never want to talk about Upstart, man.
You know what I mean?
I don't think, yeah. I don't think there's a company I've lost more money in than Upstart.
Yeah. I mean, crazy stuff. I mean, and there's a handful of those, you know? So let's kind of switch gears. I know we wanted to cover portfolio, and you know, the great thing about this, you and I could probably talk about this for hours. By this point, we probably lost half the audience because they're like, these guys are in their own universe of stocks. And like, I'm not even on this level. I don't care what they're talking about.
Yeah.
But if anybody that's still left, they're going to appreciate these next parts, and probably have people fast forwarding like through that part. So what's your portfolio strategy? How do you go about your, you know, we talked earlier about having a plan, a blueprint. Tell us about, you know, what you do. What do you do to build out your portfolio?
So what I really do is I really take it from a top-down approach. What I really like to do is I like to understand. Remember how I mentioned earlier in the conversation where I said I like to understand the why. There's major trends going on in this world, and if you don't, and that's I think where a lot of bears end up missing this, and that's where I think a lot of people, when they don't believe that productivity can really accelerate in the coming years, they're not looking at what's really going on. Eric, we are in the middle of an artificial intelligence, a productivity boom. Like, you can actually see the bifurcation between labor force participation and productivity. And it's just at the beginning phases of it, because you do have stocks like UiPath, which I don't own, but you have these amazing tools that are being built these days that's all driven by data, artificial intelligence, and basically infrastructure, right? My idea when I'm investing right now is I'm trying to figure out what today is. Where are we today? Where are we going in the next 10 years? Because I'm thinking 2030 as well. What are the next 10-year winners? What are the next CRMs, right? What are the next Adobes? What are the next Googles or Apples? You know, because those are the big winners of the last 10 years. Who are the next big winners of the next 10 years? And which ones are going to be like the ones that are going to be major beneficiaries? And then you look at the infrastructure stocks, where before it was going to be B2C, right? So you saw a lot of B2C stocks. Now what you see is you see B2B stocks. And these companies, I don't know, you tell me, have you ever seen a company like Datadog before that is growing 80% year over year with a 20 to 25% free cash flow margin, with like 125 to 135% net revenue retention rate?
No, I mean, not really. I mean, especially when you add net retention rate. But yeah, I mean, it's definitely in its own, you know, class. And what's crazy about that stock is,
and Snowflake, dude, they were 400 million when they IPO'd in 2020 at the back half of 2020. They're doing 2 billion this year.
Right.
In 2 years, they went from 400 million to 2 billion.
Yeah, no, it's pretty. I mean, like with Datadog, it was one where right at the IPO, I bought like some of those stocks, like the Datadogs and the Cloudflares and CrowdStrike even. And then I remember we started Discord in like July of 2020. So that was 2 years ago. And one of the first stocks that we bought was Cloudflare, and then it was Datadog. And I remember Datadog was like in the 60s, and I just kept buying more, like dollar cost averaging up. And I'm like, you know, these guys are doing great things. And the numbers weren't even as impressive then as they are now. But like knowing a couple of people that work there and just understanding like where the business is trying to go. And you look at it now and they're making that come to fruition even more so than you would have thought. And what's really cool about it, we have a member, one of our founding members works there, and we did like a Patreon exclusive. It's like a 1 hour video. I'll get that video to you so you can see it, but I get to interview him and talk about the company. And he basically, you know, went through the whole company. We talked about the history. We talked about the TAM. What's really interesting about that company is like the whole cyberspace, how it's really untapped, and they're spending a lot of money to develop in that area. And it's this whole like separate part of the business that hasn't even been tapped yet. And they're already doing all these great numbers, but it's so easy to scale into so many different areas. The same with Snowflake. And I think most people just don't understand like the scope of that total addressable market until it's too late, you know, and they miss the boat by the time they see it. And that's how a lot of these great companies are. The Salesforces, you mentioned Adobe. Adobe was more of a transformation play where they went from CDs to software as a service recurring revenue. And you're seeing that with like Autodesk now trying to go to that route, but Autodesk is much more of a, it's an older company. It doesn't have that exciting hyper growth. When you think of these young companies though, like if you're young and you're in SaaS and you want to sell software, there's only a handful of names that you really want to go work for. And the ones that you're talking about, those are going to get the best talent. They're going to retain the top talent. They're going to continue to expand. Nothing lasts forever though. Great companies.
Yeah, and they won't last forever.
You'll have runs and they can be disrupted too. But right now, you asked the question, like, if I see anything else like it, I mean, it's definitely in its own class. There's only a handful of stocks. Those are the stocks that we're going to talk about next, of what I'm trying to buy, what I've been adding. Those are the ones that really stand out, where there's nothing really like it, like those 4 or 5 stocks that I've been focused on, in my opinion, in the market today, or even that I've maybe ever seen, except maybe the FANG stocks. These could be like the next FANG stocks for some of these. So
like Zscaler, Datadog, CrowdStrike, Snowflake, which I do think has the potential to become a $1 trillion company one day.
Yeah.
And I'm going to throw one on your radar. I'm not sure if you talk about this, and I'm not sure it's a controversial stock, but Palantir. I do think the people, I don't want to be clumped into those guys, right? The retail investing community. But if you look at what they're doing with Foundry, because that's their commercial solution, and what they're doing, and they're growing 100% plus year over year on the US commercial side of their business. And they have historically been government, and their government has slowed, which is why they're seeing slowing revenue growth. But their commercial business product is growing 100%, much like Confluent. Confluent's doing the same thing, where their cloud business is growing 190%. For people to see, oh, they're growing 60%, and they're negative cash flow. It's like, well, you know what? They got $2 billion in cash, and then they're burning like $10 million every single quarter, and then they're scaling 190 million or 190% year over year in their cloud product, which is now 26% of their revenue. Yeah. So it's like, there's just an amazing thing going on these days.
A lot of people don't know this, but the first financial YouTube channel to bring Palantir to YouTube was Fired Up Wealth.
No joke.
And we bought it the day that it came. It was direct listing. So we all bought it at like $9. We bought it at $9 and it ran up to the 20s, and we're like, yeah, we're awesome. And we're like all flexing, I had memes like, buy it, Palantir, buy it at 10 or buy it later at 20, and then it goes to $6 and you're like, well, and I remember I even bought more of it as it was going, so I bought it at 9 and I bought more higher. And I think my cost basis now is like $13 or something, which isn't terrible, but and I've got what I consider a full position in it. It's like 1% of the portfolio. I'd probably add a little bit more to it if it went lower, but I agree with you. I mean, that's one that I was bullish on it before it even went public. In fact, this is something I talk about in that first video back in 2020. I waited for that company to go public for like 7 years. They would always say, oh, we're going to do an IPO, and be all excited, and then, oh, they don't, and then 2 years later, oh, we're coming out with the IPO. But they've been around for a long time. And it's like, they were always talking about IPO and they didn't. So I don't know if you watched the interview with Blend Labs, and that stock's been crucified, with this conditions, but Nima Ghansari is the CEO. He was one of the first Palantir employees back like in 2008. And they did a lot with the banks back during the financial crisis or whatever. And so it's kind of a cool history there. But anyway, yeah, the problem with Palantir is that there's a lot of people at Palantir that own shares for pennies, like that have a lot of stake in the company that, they basically can sell it even at $6. They can sell it, make a lot of profit. And I can't remember the number of shares outstanding, but it's a stupid number. And they've continued. And a few of these stocks that we talk about, you think of stock-based compensation, SBC, the Palantirs and the Snowflakes, they're pretty aggressive. They're trying to trying to attract and retain top talent, but there's kind of a boundary you cross too. I mean, I worked in tech. My wife works in tech. She gets stock-based compensation. I get it. But some of the numbers on SBC on a handful of these companies are just kind of, even like Datadog. Datadog isn't that bad considering their numbers. Like that's where I kind of want to be. But then I look at like a Snowflake. I get it. Slootman, Scarpelli, they're legends. They took ServiceNow and built it to what it is now. You know what I mean? they've got that track record. But somebody asked me in Discord the other day, it's like, well, there's no denying. I mean, you're ignorant if you're denying the fact that some of these companies are built in a way to make people wealthy. There's a greed component to it. Like the executives of a handful of these companies like Palantir and Snowflake, if you really want to get rich, start a tech company and make it go public because you're going to get rich. And if you're in the driver's seat, you're going to structure that stuff so you get paid a lot of money too. And with Slootman, it's not his first rodeo. Like he knows what he's doing. He's going to get paid. You think of like Peter Thiel, right? With Palantir, like he's going to make sure he's getting paid on that, right? PayPal Mafia is behind that. So that's why a lot of people get, kind of turned off by that, especially if they're not used to tech valuations and SBC and tech. But there are a handful of names that kind of push the boundary where even I say like, okay, you could probably pump the brakes a little bit on some of this stuff because you're diluting the shareholders. And it's like, I get you're growing a lot, but at a certain point, enough's enough. So I don't know how much time you spend on that stuff, but I need to do like yeah.
Because I really look at the financial statements a lot. And the only reason why I own Snowflake and Palantir is because I'm thinking 20 years.
Yeah.
Like that's really what I'm thinking, is because both of these businesses are running such great margins with the most amazing opportunities that it's really, really hard to fathom a world where Snowflake and Palantir don't exist. And this is the most interesting thing too, is that I'm bullish on both of the companies for two different reasons. Snowflake is operating as this like warehouse, right? This data warehouse, but what they're doing is they're building it out so that people can actually build applications on top of it.
Yeah.
So now what we're looking at is we're actually looking at what could be considered as the AWS of the future, because they're running a multi-cloud strategy. So now you have both exposure to Google, to Amazon, and to Microsoft all at the same time. And you can consolidate data from multiple different applications and build new applications on top of it. Like people don't understand how important that is with Snowflake and how much of a crucial role that's going to play in the future.
Yeah, that data sharing and like the advertising component too. I mean, there's some crazy stuff that's going on that people just don't talk about it. A lot of them don't understand it. Even like you talk about Palantir, there's, a dozen channels that only do Palantir videos on YouTube, or at least did for a while. And I'll be honest, I'm not trying to bash anybody, but 3/4 of those guys don't have any idea what Palantir does. They just regurgitate the information from a slide deck or whatever. Like they don't understand it. Like if you haven't worked in that field or really studied it in real detail, like there's no way you can truly understand that SaaS world and just how it all kind of, flows together. Even like Slootman at Snowflake, just having him there will attract the best sales talent. You talk about 20 years. That's, he's 63 years old, I believe, off the top of my head. You can look it up and see if I'm right. I think he's 63. He's not going to be there 20 years probably, right? So what's that look like? Well, ServiceNow, he was the CEO of ServiceNow. Scarpelli, who was with him as a CFO, is now at Snowflake. Bill McDermott, who was SAP CEO, is now the CEO of ServiceNow. They're doing great things still, but they got a really good CEO to kind of take his shoes. So, Tesla, what happens if Elon Musk is out of the picture? Something happens to Elon.
I'd sell it. I'd sell it tomorrow.
Right.
I really would.
Yeah.
So this is the thing too about Tesla. I missed it. I watched it in 2020 and I watched it keep going up. Said it's a bubble, because, obviously I was following the narrative.
Right.
I missed it and I owned it when it was under $1,000 per share pre-split. I did actually own it. I think it was like $700 or $800 that I owned it at. People still miss the boat on Tesla. I don't know why they were missing the boat still. When you just need to listen to one earnings call.
It's still a buy right now, I think.
I think it's absolutely a buy right now. This is not a car company. This is an artificial intelligence company.
Exactly. Yeah. I agree.
Because they got Optimus. Nobody's talking about Optimus. Nobody's talking about how important it is that basically Tesla, when they are doing these autonomous vehicles, what they are doing is they are creating the best way that Elon Musk described it is that when we are driving, we have to make decisions through visual interpretation. They are re-replicating this within the car. And that's how they are basically creating this. It's a robot. The car is a robot.
Computer on wheels.
It's not that it's an EV.
Yeah.
People think that it's an EV company, which is why I think Rivian, Lucid, they're going to go out of business because they're not Tesla. And people aren't buying Teslas because it's an EV. People are buying Teslas because it's technologically advanced.
Yep.
And they're also creating this other robot. And Elon Musk has went on record multiple times saying that Optimus could arguably be bigger than Tesla. Tesla is the cars.
It's interesting. We have a guy that's a mega bull in our group, Derek, and we do platinum calls. So like the platinum members, we do like a monthly call where we get on a Zoom call. There's, 20, 30, whatever people can show up. And we did a video, and he actually did a slideshow presentation on the robot part of it. It's pretty interesting. It's fun to speculate on it too.
It's nuts.
And,
it's going to come out this year. It's coming out this year. They're going to have it at their investor.
But like, just leave that part out of it. People will say like, okay, so my gutter guy, I got new gutters the other day. He's like, so what do you do again? And I kind of told him, and like, so what do you think about Tesla? I want to buy should I buy some Tesla stock? Like, I don't understand Tesla's valuation. Their valuation is higher than all car companies. They just make EVs. And I'm like, oh, hold on. Like, and I said exactly what you said. I did a video, I don't know, part of the AI series where I said, number one AI company is Tesla. And I got a lot of lashback from that. Like, it's a car company. They've been building this AI database for, a decade. This is the main reason why anybody that is a SaaS fanatic would look at it and say, okay, you've got my attention. FSD, $299, $199 a $299 option, but $299 for fully autonomous FSD. That's per month. That's per user. You think about millions of people paying $300 a month to have this subscription. It's basically SaaS, software as a service, where you've got fully autonomous, but not only the millions of Teslas that they're going to be able to do this for. They're like, oh, well, Ford can make EVs too. Yeah, but do they have any sort of artificial intelligence? They have any supercomputers, any of this data, like all the data they collected from years and years? They're going to have to lease that from Tesla. And so you're going to buy a Ford, and Ford's maybe going to, if this works out, I think this is a possibility. You're going to buy a Ford EV, and Tesla's still going to make money off you because you're going to be using their FSD. Ford's making to make 30% margin on it or whatever, and Tesla's still making $200 a month off of your FSD. You think about how many millions of cars will get converted when eventually you'll have the narrative where politics are going to force no more gas combustion engines. Europe's done it. California's already put dates on this stuff. By 2030, it's like, you're not going to be able to have a gas combustion engine. You're going to be forced to get an EV. And if nobody else is even close on this AI technology, they've got a monopoly on this. And maybe people will say, well, Volkswagen can catch up. Well, maybe they can, but they better get going, because they got 10 years of data to catch up on. And not only that, they're building all their own chips now, and they're building robots, and they're light years ahead of Ford and GM.
3 to 4 years.
Yeah. But think about how much revenue that is, recurring revenue, for that subscription as a service type, fully autonomous FSD. That's the part for me as a software guy where I started saying, okay, this is something I need to buy more of. I bought it in 2020 around that split and did really well on it. And then that's one of the stocks I've been accumulating. When it got down in the 600s, I've been buying more shares of that. Yeah. So, all right. So we could probably talk about Tesla and those other stocks all day. Kind of back to your portfolio. I think we digressed a little bit off topic. So back to your portfolio, kind of your philosophy. You said top down, right?
Yeah. So I really take a top down approach, take a look at the broader trends that are going on. And oh gosh, what's her name? Beth from IO Fund. I think that she said it best, because I was listening to one of her webinars one time.
Yeah, Beth.
She said, she said, there's trends that go on in the economy, and you got to find the stocks that are going on in with those trends. Yep. That's really what I'm focused on, because a lot of people think that you can't find winners. And I think that those people don't necessarily believe in themselves, because it really isn't that hard at the end of the day. Yeah. You have to find a company that has a strong business model with a durable competitive moat. So you have to understand the competitors that are out there, and you have to understand what the business does. But more importantly, the most important thing at the end of the day is they must have a strong balance sheet, income statement, and cash flow statement. Like, those three financial statements are things that nobody on Twitter talks about, nobody on YouTube talks about, but
I
they
talk
are
about
the. I know you do, but they are the lifeblood of a company. That is the medical records to an athlete. The way I always try to think about it is like the companies are athletes, and we got to pick the people who are going to win the marathon. What's really, really cool is that we can take a look at what the athlete looks like on the outside. So we get to judge by what they look like on the outside, which is like the story, right? And then we can also take a look at their medical records and then also their previous records too, about all the triathlons that they may not have won. That's basically what we're doing. And nobody wants to think about that. And nobody wants to say like, D-Local, for instance. Nobody wants to think about the 180% net revenue retention. Nobody wants to think about how Amazon, Microsoft, and Netflix are doing business with them. Or DD, and then nobody wants to think about what the competitors are like, what their competitors are out there. You know, so like every single stock that I'm focused on, I find it really, really tough to buy mature companies. I find it really, really tough to buy it mature. And that's not because I'm trying to be ignorant. It's not because I'm stuck in my own ways, but it really is more or less like there are game-changing companies out there right now. And they are still performing despite this macroeconomic condition. Yep. And a lot of these calls that I listen to, like Zscaler, like I mentioned before, or Sentinel-1, CrowdStrike, they are saying, we don't see anything wrong. We know that our customers but they're so indispensable to their businesses. They are so mission critical that people want to just completely overlook them because of, I don't know, Sentinel-1 right now is unprofitable, or maybe because stock-based compensation is a little high on Zscaler.
Right.
But when you have that sort of durable competitive moat, that's a special thing. And that's where I want my money. I want my money in places where I do believe that over the next 10 to 15 years, I can become a millionaire off of. Yeah. And I'm not trying to speculate, trying to say, YOLO, like I'm trying to become a millionaire right now. No, it's really much more along the lines of like from 2000 to 2012, if you would have followed Microsoft's story and if you accumulated the whole time, if you would have just understood what Microsoft was doing as a business, that they were continuously improving as a business, Apple too, or Amazon too, and you didn't sell when everybody was panicking and you just kept on accumulating, and the next thing you know, you just spent the next couple of years of your life and now you probably have a really, really nice home. That's the way I look at it.
That's why I fired up Wealth Exists, basically what you just talked about. I mean, those FANG stocks that's what grew my wealth. And you talk about finding those next FANG stocks, and that's what we're trying to do. So I have lots of things I want to say to that, but before I do, I want to kind of keep it in the right order. So you're talking about the portfolio, like I get it. Like, so Fired Up Wealth is very much the same way. When we think of our growth segment, we're trying to focus on those secular growth trends and talk about all the time, like semiconductors, new oil that kind of fuel all that. You got AI, you got robotics, machine learning, cybersecurity, SaaS, EV, Metaverse. There's all these secular growth trends that could be huge. And even like e-commerce, which is an older one, 5G, 6G, and so on, Internet of Things. These are still secular growth trends that are going to continue to expand. You think of things like, Amazon's going to start doing their own low orbit satellite, right? Internet. And you've got the same thing with Starlink, right? With Elon Musk Starlink. Might not seem like a big deal, but think about how many more people are going to connect to the web, to the grid. And now as you're talking about things like D-Local, or you're thinking about e-commerce or all these different companies like that, we don't even know what the TAM is, because think of how much that TAM can expand when all of a sudden, rural areas that didn't have access to the internet are all of a sudden part of that network, and that's only going to continue to accelerate. But when I think about how you answer that though, so I get you're trying to build a portfolio based on secular growth trends. Your portfolio is unique because you're not really going for any balance at all. You're going for basically, highest risk reward beta. I mean, correct me if I'm wrong. I'm not trying to put words in your mouth. You're trying to find the stocks you think are going to be the biggest home run balls, but not not like YOLO, but like ones where you do homework and say, these are the highest growth type winners. I'm probably not going to be right with all of them, but if I'm right on 6 or 7 out of 10, like Peter Lynch, you're going to make a lot of money. Am I correct in saying that?
So I cut stocks pretty quick.
Yeah.
So I'll sell stocks very, very quick. If I think that it's something and then they show me that they're going to be something else, I cut it. There's 3 good examples that I can tell you about. Digital Turbine, where I thought they were going to be something. And after one earnings call, I said, nope, done, out of here, right? I don't even care. I don't care how much down I am on the position. I'll cut it, right? DigitalOcean, same thing. I said, oh, the CEO right now is doing a stock buyback during this macro environment when they have about $1 billion in debt and they have $700-800 million in cash on the. This is not the right thing to do. This is not long-term thinking. I'm out, right? Or even what's the other stock that I just sold? Silvergate Exchange, because I was believing in their stablecoin infrastructure, and then I was also believing in the long-term thesis of the Web3, but they also had nice exposure to regulated banking. And what I saw a lot of crypto exchanges blowing up, and the first thing I thought to myself is, nope, I'm out. Like I just sold, right? So I'm not necessarily trying to hold these things to the grave. The best way to say this, Eric, is that I am not trying to do anything other than what an investor really should do at the end of the day. Buy great companies. I don't know. There's really no other way to say it. Like, I know Costco is a good business. I know that a lot of these other mature businesses are good businesses, but I scrub hours and hours, and I scrub ticker symbols, and I try to understand like what fundamentals are of this company or this company over here. And where I really think that my experience helped me out a lot was when I worked at Gartner. I was working with many, many different companies, like in multiple different industries. And I got a chance to understand each and every single business model to a point to where like I was working with the CIOs to understand their business model, to understand what we could do to plug in our solutions into their business model.
Sure.
So what that happened is that later on in life that I could actually research these business models and understand what they were doing at such an in-depth level to where I have a very, very difficult time putting my money anywhere else. And it's not because I don't believe in diversification. It's not because I believe in having a low beta portfolio. It's not because I believe in the macro trends or because I understand all of it. The only thing that really, really makes sense to me at the end of the day is if this business is a wonderful business, why would I not put my money there with only such a limited amount of capital? Now, if I start scaling my portfolio, I'm not a millionaire yet, but I will be. When I'm a millionaire, do I think that I'm going to have those buckets like you do? Yes, I do think I'm going to have some SPYs, some QQQ, some other ETFs, and probably a couple dividend stocks to make sure that I can because at that point it's wealth preservation mode, right? But now,
see, I agree with what you're saying to an extent, but here's the thing. 9 out of 10 people that say they can stomach that volatility, they can't. In fact, even Fired Up Wealth, I've been teaching from day one, have ETFs, have dividend stocks. Well, guess what? Most people don't buy the ETFs, the dividend stocks. They just do exactly what you're doing. But when this market goes down, a lot of them are, freaking out like, oh my God, like this stock's down 80%. Well, yeah, that's kind of what you signed up for when you're going for, swinging for the fences on every pick, So I get what you're saying. Right. It's interesting. I think we agree on every stock on the planet except for Digital Turbine. I have it more of a speculative asset, but I do think that company with time will do well. I think the tricky part, one of my rules is with the story changes to cut losses. And there's a fine line there because some of the best stocks that I've made my most money in, including like an Amazon or an NVIDIA, they went through problems where most people gave up. But if you didn't give up, that's where you made a lot of money on those stocks. And so
really,
I'm not judging what you're saying, but there is that slippery slope where the best companies in the world all go through some sort of adversity, and they're not going to be perfect the whole way from A to Z. Even Apple, you look at any company that's done really well, they haven't been perfect quarter over quarter over quarter. Having discipline is not a bad thing. If you think the story changes, you cut your losses. But what I do want to draw to the audience is that it can be a kind of a fine line too, where if you're researching these companies on a different level and you've got a different insight, where some of the people that maybe aren't doing that, and they hear like, oh, well, this quarter didn't go well, I cut it and I move on. But you might have a different insight than like, someone over here that's not spending 20, 30 hours of time per week researching stocks. I really do think though that there's this fine line between cutting your losses if the story changes and a company that is going through a growth pain that will get to the other side. There's really, that's so black and white, it's a gray area of how you interpret that and how I interpret that. But I will tell you that you think of like the biggest winners over the last decade, even NVIDIA in 2018, nobody wanted to touch that stock with a 10-foot pole. Tesla in 2019 was going bankrupt. No, you said it was in a bubble earlier, but in 2019, the narrative on CNBC was it's going bankrupt, that, there's a 99% chance that company was not going to be in existence in a year. And now CNBC. It's in the S&P 500. So some of the best winners are ones where the negative sentiment can get really bad, but it's this fine line where it's like, it's bad. And you see something that seems like a red flag and you overlook it. And then a year later, you're like, why didn't I see that it was going to get a lot worse? And it's easy in this kind of market because everything goes lower and people use stock price as the justification for the business, like, oh, well, D-Lo went lower, so it's a bad business. Well, no, the stock is broken, not the business, like we talked about earlier. So anyway, I digress, but I will say that I think we agree on every stock except for that one stock. And I'm not saying that they've been perfect the last few quarters, but I think they're going through some growing pains because of those acquisitions. And it's really going to come down to if they can get through that. You're on the side where you think maybe they're not going to get through those growing pains and you don't like the CEO maybe as much, right? Am I right on that?
I love Bill Stone.
He's a character, right? He's a character. But
he's smart. Like if you read his biography, he's done a lot of great things. And Fubo is actually another one that I constantly follow. So like, I also have another philosophy. If the thesis is changing or if I'm worried about the business, I do cut it, but I constantly follow it. So like STEM is another one that I follow. These are speculative long shot bets. But like even Upstart, as much as that stock has hurt me, I still follow these stories over time. Yeah. And even if they're having a hard time, just like you mentioned, the truth is that they can go to zero, which concerns me. And I think that concerns a lot of investors. But at the end of the day, it's like, if the thesis and if the story starts changing around, then I don't think that there's anything wrong with coming back to it. That's just my opinion. That's just my opinion. Because the way I manage risk is I think that traders manage risk in a different way. They perceive risk as volatility. I don't perceive volatility as risk, but it's more or less like risk is business risk, like going out of business or a deterioration of the business model, because that happens. That happens. That happens to like 70% of stocks.
Yeah, no, I agree with that part. And like I said, I'm trying to find my 15 investing rules because I was going to kind of read through some of these, but one of them is
on your Twitter, isn't it?
It's kind of all over, but if the story changes, cut your losses, move on. Well, that's subjective, right? Like, what does that mean to you? And what does that mean to me? It's fine. I'll put it up on the screen so people can see it, but so that this is where investing's personal, what you believe in and what you invest in is going to be different than me and different than other people. And there's not really a wrong answer because everybody has a different answer. And it's important to like both of us share our philosophies because there's no wrong answer and there's different risk tolerances. Some people like the idea of having some ETFs as a core because it helps with the beta. When things are volatile, you're not losing as much, like there's a lot of ways to look at it. You say, well, if I'm going for the fences, this. When I was younger, I invested in a lot more speculative assets. I didn't really have the core So like I have this master class, and I hate to plug this, but you talked earlier about like balance sheets, and you're talking about like, accounting's the language of business. I've got 12 classes. If you go through Patreon, you can get, it's 11 and a half hours of content. It takes you from A to Z. And it's basically like, I spent 300 hours making this, 300 hours. Like if I were teaching my 20-year-old self what I need to know to be successful, here's what I would have myself watch when I was 20 years old, or when I first started investing. And it's trying to teach all the things that I learned the wrong way. One of the things that I learned along the way is that for me personally, and my risk tolerance, is I should have had more ETFs and dividends to balance it out. Because if you pick the right winners in your growth bucket, you're still going to outperform the market. But I understand the other side of it too. And I'm not judging it. Like, again, it's like totally personal. Like I've got people in my group that are 80% crypto. That's their portfolio, like close friends. And I said to him a year ago, like, I don't agree with that, but it's your money. I think that's really risky. Well, they're down 75%. I'm not saying I told you so, but I'm also saying like, there's risk to whatever you decide to buy. What I want to get to the core of this though, is what I really want to understand is if you were to make a blueprint. So you explain that you like to buy stocks that are focused on secular growth trends, but how do you allocate that? So are you looking at 20 stocks and you're trying to fill 10 different secular growth areas? Or, because with Fired Up Wealth, we've got pillars. We've got ETFs, dividend stocks, growth stocks, spec stocks. So spec stocks are the ones that might fit in like the Cathie Wood, bucket. They don't have earnings. They don't have free cash flow. They're kind of a story. It's more of a qualitative analysis, right? Where it's more of the gut and the story versus quantitative, where it's, actual physical data. So when you build your portfolio, are you trying to get 20 stocks that cover 10 different secular growth trends, or what does that plan look like?
So when I look forward, so I'm in portfolio construction stage. I own about 11 stocks right now. And I do take an approach where it's like, I think Jeremy said it best, where it's like, I am hyper focused in on the business models specifically. And I don't want to over allocate myself, because when earnings season comes around, it really is hard to keep up with a lot of that stuff. And I'll even start skipping earnings calls. And I've noticed that I've done that before in the past. That never turns out good. So right now I have 11 stocks, and I'm currently building a position into AMD, right? So I have positions that I would say that vary from 15% all the way down to about 7% based on conviction. Like I said before, where one of my highest conviction stocks is D-Local, and then one down from that is going to be Tesla, right? Because Tesla is a proven winner. It's an S&P 500 stock. I would like to get AMD up to about a top 3 position. But when I look forward, right, because what I have today is not what I always want to have. And this isn't my strategy for the rest of my life. When I look forward, because I have, remember how I mentioned earlier in the conversation where it's like, okay, I have 80% of my focus goes into my 9-to-5 job. I even start looking at real estate, right? Because my wife and I are planning to get into real estate investment properties, after what ends up going on with the real estate market just kind of cools off, right? Because we all know what's going to happen. It's never different this time. But I even start looking at that, right? But let's talk about specifically stocks. I want to build out AMD, and then from there, what I want to start doing is start accumulating over this next quarter's earnings. So this is the medium-term goal. Start accumulating over this next quarter's earnings, and then see which companies are still performing well. And then what I would like to do is actually narrow it down even a little bit further, and then actually start diversifying out into SPY and QQQ, and then actually build that to be about 50% of my portfolio. So I have thought about this in the future because my portfolio is so new, right? Because I started investing in 2018. So it's under 4 years old. And I can imagine that what that looks like when it's underneath 4 years old. It's not, $1.6 million or anything, or $2 million. So at this point, it's like, okay, I make up, I'm not going to say how much I make, but it's in the hundreds of thousands of dollars a year, right? And then if you add both my wife's and I income, then all of a sudden now I can put in $1,000 a month, and that's really what I'm focused on, is that building positions in companies, building positions in where I want it. And then as it starts to get bigger, I do want to reduce beta and then start going more into the indexes to make sure that, yes, my portfolio kind of keeps trucking along with the major indexes, but then I can pick the individual companies that I think will actually be really, really good over time.
So this is where we always come back and we're like on the same page, but like, this is where I don't want the viewer to be confused. Cause like when you're talking about 11 stocks with 15%, like
it's a strategy.
People that follow me, you know, I learned the hard way. Don't go over 5% on anything ever. Yeah. And again, it's your prerogative and it's like, it's your portfolio and you're doing what you think is best. I did that too. And I learned that it's not always the best. And I'm not trying to criticize, but I'm trying to give perspective to the viewer. Like you've got this opinion over here and you got this opinion over here, and you can choose whatever's best for you, because at the end of the day, the person watching, you're going to do what's best for your money, because we're not financial advisors. We're just telling you opinions. Right. But I used to invest that same way. And then you have one stock blow up and you got 15% allocation and it destroys you. I mean, you can't recover it from it. You know, it loses 70% of its value overnight and it doesn't come back. You know, you get this overconfidence, like, well, Tesla can't do that, or DLoca can't do that because I've done this much research. At the end of the day, here's the thing that I've learned though. No matter how much research you do or how much you think you know, you really don't you don't know the business, because you're not the CEO. Like you only know what you can get from data from 10Qs and, you know, and 10Ks and from earnings calls, but you can't ultimately control. Like you could have been an investor in Enron and it was the best company in the world. You didn't really know what was going on behind the scenes until it already happened and you're done. You lost all your money. At one point, that was the one stock. It was like the Microsoft of its generation. Like everybody, you had to own it in your portfolio. It was a must-own stock. It was the NVIDIA or the Microsoft. And if you went 20%, 30%, 40% into that stock, you got your ass kicked. You never recovered from it. Now, when you're young, you're at a point now where you're trying to build up. Like you said, you're in this appreciation phase. If you're in capital preservation, your portfolio is different. You're talking about how you want to build, you know, ETFs to be 50%, so you don't have to focus more on it. I think it's good. Like for me personally, I think that you don't have to necessarily wait. You can make 10% of your portfolio an ETF and just kind of trickle that in while you're still doing this other stuff over here. So again, I'm not here. I think you do great things. Like at the end of the day, you're a smart guy and you're doing what's best for your money, your portfolio. But I also need, like for my viewers that hear me talk about, like, here's why I do the things I do, why you should have this, this, and this. I need to at least explain from my perspective why I think, because I've been on that side of the fence and it didn't work for me. Hopefully it works for you. What happened to you? What's that?
What happened to you?
No, I had allocations that were high. When I started investing, I would have 10 stocks, thinking like, I know these stocks really well. You'd have 2 or 3 that didn't work out. It's hard to, you know, recover. When Peter Lynch says, like, if I can get 6 out of 10, he's not talking about owning 10 stocks. In fact, there's times where Peter Lynch owned hundreds of stocks in the Magellan Fund. You know, it's a numbers game. I don't know if you followed like modern portfolio theory. Either you believe in MPT or you don't. But modern portfolio theory will show you that, like, just because you have a ton of stocks, it doesn't mean that you'll underperform. And there's these two camps. Like people always use Buffett. Well, Buffett only, you know, he's got 6 stocks or 50% of his portfolio. You know the problem, the flaw in that story, right? Berkshire Hathaway is not just publicly traded stocks in the portfolio. That's a small portion of the actual assets. And if you really look at it, Apple is not that big of a concentration of Berkshire Hathaway, but they only look at it as the publicly traded stocks within Berkshire Hathaway's portfolio. And nobody even understands how Berkshire Hathaway really operates, or, you know, how many companies are really involved in that. It's basically an ETF. Berkshire Hathaway is an ETF. It's the only stock that you can buy that's not really an ETF. That's an ETF, from Dairy Queen to everything else they own, Geico, whatever. But people always use the Buffett thing, like, oh, well, Buffett was over concentrated and it worked out for him. That's not true. It's not true at all. If you actually look at Buffett and you look at true ownership for private assets and publicly traded, he's very diversified and there's not a lot of concentration. He's only concentrated in the publicly traded stocks. And that's what people fixate on, that, oh, he owns this much percent of Coca-Cola and this much Apple, and it's this percentage of portfolio. That percentage of portfolio is just the publicly traded stocks, not the private businesses, because you don't have that information. And this is where.
So then my question becomes, like, when you own too many stocks, I feel like it does, and I've owned a lot of stocks before. I've owned 30, 40 stocks. And it becomes too much to follow along with all the stories and all the earnings reports
that's the only
all the news releases.
That's the only disadvantage. The only disadvantage is that the average person can't really keep up with that many stocks. And I tell people that all the time.
That's the biggest reason why I only own 10 to 11.
But
it's hard.
Yeah. But like that diversification to have more holdings, it hedges risk. And to your point, like if you're shooting for the fences, you don't need to hedge risk, but like you've already addressed the issue. You're going to start going into more ETFs, 50% of your portfolio. So you understand that it's something that you're going to address. I just want to paint that picture to the audience so that a new investor doesn't come on and be like, I'm going to follow Dillon, because following Dillon's not the best thing, because Dillon is kind of his own class of due diligence that you're not going to see.
It's not the best thing.
Yeah.
And I know that it's not.
Yeah. So that's a good segue, because one of the things we want to talk about is stocks you want to buy that we're focused on for a portfolio. And I always have to kind of paint the picture, like, just because I'm buying it doesn't mean that you should buy it. And I made the example before we started recording. I bought Microsoft in 2012, and I get this all the time. Like, well, if you still think Microsoft is a good company, you could still buy it here. Okay. But see, the way I do it is I build a blueprint. So we're talking about portfolios. You're focused on like secular growth trends. You got 10 or 11 stocks, and you're kind of concentrated. I'm doing the same thing, but I build a blueprint where I want to have a percentage of assets in ETFs to really just have a foundation. So you're building a house, you want to have some kind of foundation to build your walls on, right? So something that it's always going to be there. You can rely on, you can add to it. It's not going away. Your dividend stocks, which I understand why some people wouldn't want those, because they're not going to give you the highest risk reward. But we're focused really on DGIF, dividend gross invested required, where it's like, they're not hyper growth stocks, but they hopefully will be like a Microsoft when you bought it in 2012 that will grow into something special. And those are hard to find. There's only 10 or 20 stocks that even fit the criteria, but those are good compounders. They give you a little bit of diversity. They're much more of a value trade than, say, a Snowflake that's trading at 14 EV/NTM or whatever. It's giving you a little bit of a hedge, a little diversity. And then you've got your growth stocks, say it's 40%. You got spec, which is the stocks that, you don't have as much conviction in, or it's more of a story stock, qualitative versus quantitative analysis. And I build my portfolios that way. And it could be 30 stocks, 20 stocks. It depends on you. Some people have more, some have less. Some people started and fired up wealth and they had like 50 and they're like, I can't keep up with, to your point, and they scaled it back to 20 or 30 or whatever. But when I think of the stocks I'm focused on now to buy, and I always say, like, just because I'm buying Snowflake, it doesn't mean that you should buy Snowflake. I'm buying stocks that fit my allocation for my risk tolerance, my blueprint, my portfolio, based on a 2030 target. And what I'm trying to do is like build out the growth part of it, because I've got 42% of my portfolio is dividend paying, which nobody gets that. Like, people that follow me on Twitter assume that like I only have SaaS stocks, which is not the case. So I've got like the Costco's, Home Depot's, United Healthcare's, all kinds of boring stuff that you don't even want to talk about, right? But they're stable stocks that I've owned a long time, and they've done well for me, and they just accumulate wealth. That's what they're there for. They're not going to hit home runs, but they're going to give me doubles and singles. And sometimes that's all you need. And the more money you get, the more you want to kind of get to those doubles and singles, because you don't have to hit a home run every time. You just have
lots of dividends, man.
Keep getting on base, right?
That's a lot of dividends.
Yeah, and dividends do add up. At one point, I was getting a lot more dividends, and I've adjusted the portfolio. So 42% of my portfolio pays dividends. I have 10% ETFs. Now, people are surprised by that, because I'll say, like, if you're building a portfolio, you should have 30% ETFs. 100% of my retirement is ETFs. Well, 97%. I've got some AbbVie and a few others, but everything I focus on in my retirement is all ETFs. If I want growth, I focus on growth ETFs. I'm not saying it's right for everybody, but from my experience, I can't tax loss harvest. So like, if you buy a stock and it loses 50% of its value and it's in a Roth and you can only put $6,000 in a year, you're screwed. You lost that money and you can't get it back. If I have it in QQQ, if QQQ goes down 30%, like no worries. When I need the money in 20 years, it'll be worth more.
Yeah.
So ETFs in retirement, I've got 52% in either dividend or ETFs in my tax, $1 million plus taxable brokerage. And then I've got, the rest of it's growth and spec. And so when I think of my growth, it's like, I'm focused right now on Snowflake. I'm focused on, Datadog. I'm focused on Zscaler, and I'm focused on Tesla. And all those stocks, to your point earlier, I bought them at these levels or lower, and they haven't made new lows. Even as the market's made new lows, these already bottomed out weeks ago. And maybe they still will make new lows. If they do, I'm going to add more. But like Snowflake, if it doesn't go to 110, I'm not buying more shares. Zscaler, if it doesn't go to 120, I'm not buying more shares. I've got numbers that I write down on a notepad. And it's like, I made a video earlier today about this. Like, I allocate using dollar cost averaging, using technicals. I buy at levels, and I'm focused on those 5 stocks. It doesn't mean that those are the stocks you should buy, but those are the stocks that I've been buying over the last couple of months. And if they go lower, I'll add to my portfolio. And I'm trying to build out that kind of hyper growth part, because I think these are attractive prices for those stocks versus paying $400, for Snowflake and $1,000 for Tesla or whatever. They're much more reasonable levels at these rates. So those are the stocks that I'm focused on right now. How about yourself? What are your top?
I'm going to do 3 assets. I'm going to say assets because my wife's laughing at me because we're still talking 2 hours later.
Oh yeah, I'll talk all night.
I'm going to do 3 assets. I'm accumulating AMD right now. I really, if I could give financial advice, I would say that you should probably strongly consider AMD, because right now they're at a forward PE of 19. Their balance sheet is A+. Their cash flow is incredible. It's like 20%, I think. And then their operating cash flow. It's just all around. And Lisa Su's a boss. Mm-hmm. Lisa Su, she is just an incredible CEO. What she has done at AMD, they're right there at the heart of every single secular growth trend. And I cannot believe I've missed it. I think that I didn't buy it before because it had like a forward PE of 40. And I'm like, I'm not going to buy that stock when it's a forward PE of 40. But now it's 19. And I'm like, okay, full on accumulation mode at AMD. That's what I'm buying right now. I already own Snowflake. I feel comfortable with my position. I own Zscaler. I own Datadog. I would like to own a little bit more Datadog. So I'm right there with you in all those stocks, but they're full positions where I really want them. And then also Mercado Libre. Yeah. I do think that it's ridiculous. It is ridiculous that they are trading here. Dude, they are trading. They were $1 billion. And so back in 2019, when they were $600 per share, they were doing $1 billion in revenue. They're doing like 10 billion. Is it 10 billion? It's somewhere around there.
MELI is an easy one because when the market turns, that's one of the first one that goes, bullish. It'll be a market leader. I think it's Tesla will be a market leader. Datadog, no questions, a market leader. Like Datadog doesn't even try to make new lows. It just like $85 and then back to 100. It's like it doesn't. There's no. You
just got to buy it.
Yeah, Zscaler had their earnings and it's like, oh, I'm going to get this for 110. Yeah, right. It goes, pops up to 130s, whatever. AMD is one that the group's been bullish on that one. MELI's another one. AMD, I think I just bought some. I need to actually check and make sure I'm in compliance because I think I bought it. I got to wait 2 days after I buy it when I'm doing the TMF stuff. Speaking of that, this video is sponsored by the Motley Fool. If you want to see the 10 best stocks to buy now, visit fool.com/firedupwealth. I got that in there. I snuck it in. So, but yeah, like I bought AMD sometime last week. I added more shares. And you said, you didn't buy it. You missed it. You didn't really miss it because it's back to the levels it was, a couple
2020 when I saw it moving up.
Right. So this is a perfect
like,
time to buy AMD, and they have tons of both AMD and Nvidia have share buybacks right now,
too.
and yeah, repurchase plans. It's to me, it's a no brainer longer term. You know, short term, people are worried about supply chain, this and that, whatever. Neon gases from Russia, Ukraine. I mean, there's always going to be risk, but longer term, those fabless companies will prevail. Like, you know,
my third asset.
Yeah. What's the third one?
It's going to be real estate. I'm building up a cash position for real estate because I do think the real estate market's going to go down. And I think that diversifying out away from the stock market is going to be the next big move that my wife and I make, because I do think that's going to be very, very important to the long-term wealth goal, you know, because I do think that the housing market's going to correct about 20 to 25% because interest rates are 6% right now, 30-year fixed. And I think that supply is going to continue. And even if you pull up Zillow, like in our region, if you pull up Zillow, you can actually see that there's a lot of price cuts going on right now, which is pretty crazy. I haven't seen that for the past couple of years. So the third position I'm building up is cash for a real estate purchase.
You're thinking about rental?
So I'll actually take this one. So I own this house here. I will take this house, and then I have a VA loan. So this is kind of cool. We'll talk about loans here real quick. I have a VA loan, and that's a $0 down, right? And I get a low interest rate. So what I'm going to do is actually refinance this one with a traditional loan when interest rates fall back down, and then use my VA loan for the next house for $0 down. But then I need the cash balance to fix up whatever I need to fix up. So $20,000, $30,000, $40,000, whatever it might end up being. So those are my three next moves.
Just remember, when you refinance your loan, you have to refinance it as a rental and not a primary residence, because if you don't, you get in trouble. So I used to originate loans for about 8 years, if you didn't know that. But
really?
Yeah. So
that's helpful to know.
With real estate, I will tell you this. So I was in real estate for close to a decade, had my own brokerage, was into mortgages, real estate, rental properties. We had a dozen rental properties. They can be great wealth creators, especially when you're young. There is a lot of risk to rental properties that people don't realize when they get into it, because you see, like, you know, Rich Dad Poor Dad, and it's very glamorized. It's very glamorized. Like, that's the easy way to wealth. And it certainly can be. If you don't have connections in that industry, it can be very difficult, especially if you expand more than like one property. If you've got one rental property on the side, great. If you're trying to do 3, 4, 5, you know, property managers, hard to find. We've had 4 in our lifetime, 3 of them embezzled from us. I can tell you, I could spend another hour talking about all the money we've lost from being not in a floodplain, but having a 100-year flood happen and losing $40,000 to basically fix all the damages. Like, there's a lot of things that can happen. And this was Minneapolis market, which is the market you're in. And I know a lot of people in that market. It can be really good. So people a lot of times like, why you always got to throw shit in real estate? Like, a lot of my wealth came from real estate. But I'll tell you that if I were to tell my 20-year-old self, which is the easiest thing to do and stress-free, just stay in the stock market. Like, you're going to make more money in the stock market with way less stress than messing with real estate.
Really?
Yeah, absolutely. 100%.
You don't hear that too much
from people that have never done it. That's true. Or people that have only done one. People that have only done real estate and that never did stocks, they'll tell you real estate's the best thing ever. You won't meet many people that have done both. I've done both. I'm telling you, the stock market is the simplest, easiest, hassle-free wealth creation tool that ever existed. And there's no reason to even go outside of it. I'm not telling you what to do.
In a bull market.
In a bull market, right? But I'm not telling you what to do, but I'm saying, like, there's pros and cons to it, and just make sure you know what you're getting into, because tenants are not easy to deal with. Things happen, you know. And I get it. All these other YouTube channels, they made their millions off of real estate. Well, they're all in California, and they all bought during this bull run, and they bought, you know, lower, you know. Yeah, there's circumstances that will help with that. But I'm just saying, like, it's not as peachy as it might always sound when you listen to an influencer or read a book. And I've been there. I've had a dozen properties. If you're going to do properties, don't rent them, flip them. That's the way to make money. Flip it. Buy a house, distressed house, buy a foreclosure or bank, a foreclosure type house. Buy it. If we get into a recessionary period where the market's hit, you can buy those foreclosures at a discount, pay cash if you can, buy the thing, fix it up, flip it. And that's harder to do now than it used to be because they have rules on you can only sell it for X amount of percent of what you bought it. And there's blah, 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 because, predatory stuff that happened back in the Great Recession or whatever. But you can make more money flipping properties and doing 2 of those a year than you're going to do renting. Dealing with tenants, I'd rather, you talking about passive income? Oh, that's passive. That's not passive income. Passive income is if I buy, SCHD and it pays me a dividend of 3% and I just Netflix and chill, that's passive income. Having to collect money from a tenant that will destroy your house, that's not passive income. I don't care.
Oh, that's work.
So if you want to do the work and you have the time, great, but don't listen to the hype of that's passive income. It's easy way to wealth because it's not. It can be
probably the market top.
Yeah, and certainly if you buy the right property at the right price and get the right tenant, there's all these magical things that can work for you. But I'm just saying, man, like
not usually how it goes.
Yeah, if I were to do one over the other, I would do the stock market. But at the same time, I did make a lot of money on real estate. But most of my money I made in real estate was from flipping homes, not from renting homes. And I had a dozen rentals. The big money that we made was always buying a house and flipping it in 90 days and making profits. Remodeling the kitchen, remodeling this and that, and it's fun. Like, that's interesting. It's really fun. That's if you really have time. Like, that was one of my options without Fired Up. If Fired Up Wealth didn't kind of take off, is I was just going to use capital and buy distressed houses and basically fix them up and flip them because it's really fun to do. It's rewarding, and you don't have the extra baggage with it. Like, you don't have to worry about a tenant. You just sell it. It's their problem, and you move on to the next one. You know what I mean? So anyway.
Huh. I know that's actually good. That's something to think about. That's for sure. I'm not saying that like I'm going to come back and think to it later. Like, I'm actually going to think about that because you don't hear that perspective too often. It's a valuable perspective.
You don't hear it too often. What I would say is that how many people that you hear it from have made money on both sides, and there's probably not a lot.
Not many.
I'm trying to think of the YouTuber Graham, right?
Graham Stephan.
Yeah, like. He doesn't. He made his money in real estate. I guess the same with me,
California.
Kevin, right?
Me, Kevin. Yeah, both in California.
Exactly. Like, come on. If you bought real estate 10 years ago in California, you're gonna make money.
Dude, all you need to do is just buy one property in California.
Right.
You're a millionaire.
Yeah. And then once you got the millions, everybody will listen to you on YouTube, and like now you're buying $10 million of Tesla stock, and that's gonna get views and. And I'm not taking
my house would be worth like $3-4 million in California. Yeah, honestly.
And those guys are great. Like they put in work. Like, I'm not bashing them. Like, Meet Kevin was doing like 3 videos a day. I do like 3 videos a week. Like, I don't have that grind in me, So like whatever. Like I don't hate on anybody. Like, if you make $50 million a year off YouTube, good job. I'm never going to be at that level. It doesn't matter. But, like comparing yourself to like a real estate investor in California over like the largest secular bull run in history, like, just be careful of like, it kind of that flashy object thing. Like, I'm going to get rich off of, you can make money in real estate, but it might not be as awesome as it sounds at first glance. That's all I'm saying. So I'll probably get lots of hate comments below on this, especially from people that have never done it. It's always the people, you ever notice that, like on Twitter, it's always people that have never actually done it that will criticize you. It's like, well, I've actually done it. Have you done it? Like, well, no, but I could do it better than you. Okay. Like, why haven't you done it then?
That's how I knew we were close to a market top, when people started telling me what to do with my portfolio. I'm like, why are you telling me to buy an EV SPAC right now? Like, they don't even have any, I don't even think they have a business model. It's just kind of like, so yeah.
DWAC to the moon. Well, we've talked for a while. It's been good. We'll have to do another
2.5
one.
hours. I'm getting tired. It's like 11 o'clock here this time.
Yeah, we've been at 3 hours or something like that. So
Pretty much.
I don't know what you're watching on YouTube. It's been edited, but it's probably still, you probably aren't even watching this because you've already given up by now. But, check out Dillon on Twitter. I've got both of our handles up on Twitter. Of course, subscribe to this YouTube channel. Drop a like, drop a comment. Dillon does have a YouTube channel as well, but he's more focused on Twitter and Substack.
Yeah.
So check him out, man. And, he's doing great things, and appreciate your time. Appreciate you sharing your knowledge with everybody in the community. It's been a lot of fun. We'll have to do it again, and have a great rest of your night.
Cheers, Eric. Have a good one.
Take care. See you
Thanks
later.
for having me.
All right.
See ya.